Okay, let the participants join. In the meantime, we'll do a quick summary of what we had spoken so far. So we talked about what to monitor, right? So there are a couple of things we monitor. We monitor where the point of control is getting developed for the day and where activity is getting widened horizontally. That's what where the equilibrium point is getting developed. And often point of control acts like a magnet. That's what we've seen in the past session. And we also monitor where today's value area is getting developed into with relative to the previous day. The previous day, compared to the previous day, a value area can form higher or lower, overlapping to higher or overlapping to lower or overlapping. We also discussed about the tails, right, which is a good tail, which is a good buying tail, which is a poor buying tail. From that, what we can infer, what if it is a poor low or a poor high, who is dominating over there, who is actually taking control there in the market. That's what we'll be able to discuss from the buying tail or the selling tail. And if it's a good tail, it has to be more than 2 TPOs, right? Or if it is less than 2 TPO or 1 TPO, we call that as a poor high or a poor lows. And we are not very much concerned about the precise levels of value area high or value area low, because many new traders, they trade buy above the value area or sell below the value area. That's what most of the beginners in market profile do. We use market profile only to understand what is happening in the markets, what kind of competition is going into the markets, what kind of players are coming into the markets, what kind of traders behavior is going into the markets. On top of that, we will use those information as our trading odds, right? And the fourth thing what we'll be monitoring is most of the traders have the obsession to watch the price alone. Price or price-based indicators alone, they take the decisions using that. Whereas when it comes to market profile, we are always going to look price relative to value area and the point of control, right? So we are where the price is trading relative to the today's value area and point of control, or yesterday's value area where today's price is where the price is trading. Another thing you have to understand is once the market opens, so is it opening higher or lower, where the value area is most likely to form. So where the value area or point of control is most likely to form for the day. That is one another observation. It has to be running in your mind throughout the day. So around 10 o'clock, where 10 o'clock or 11 o'clock, where the point of control is it can shift higher or lower. What is the odds that it can move higher? What is the odds that it can move lower? Or whether there is the odds that it cannot migrate for the day at all, right? So, for example, if the point of control is getting widened more than 7 TPOs, more than let's say 7 TPOs, it may not migrate at all for the remainder of the day. So what happens is that lately price might move, whereas point of control may not move at all. If the point of control is more than 7 TPOs or 8 TPOs, the remaining days odds that it has a very less chance that the point of control can shift. So these are the odds you'll have to monitor, and that is very essential when it comes to reading any market profile charts. Right, so we'll start with Vivith's question. Not able to listen. I think probably you should reconnect back. Connect. Okay. So, Vivith, may I know your question, please, again, so that we can discuss those topics. So maybe I'll I'll post these contents into the Slack as well, so that you can use it for your reference. So all these content, I'll post it in the Slack. So these are the contents. You can make use of these contents. And yes, Vivith, may I know your question, please? Again, we had a question. You can unmute your mic and you can ask the question. Okay, maybe then we continue then, and later on we'll catch up with the session, that question. So let's talk about market participants. So there are varieties of market participants. They are mostly market profile classifies as scalper and intraday. They are mostly intraday traders. Again, scalpers, their maximum trading time will be anywhere between a couple of seconds to a couple of minutes. They don't hold for 1 hour or 2 hour also. A scalper comes, he'll be looking for 5 points, 10 points in Nifty, and then he take those short points and then he move away. So basically, intraday player also something similar to that, but their holding period will be anywhere between 5 minutes to 10 minutes or hourly or 2 hourly. Maximum they come in the same day, they close their position in the same day, they don't carry forward with any of the positions. And mostly these days, many algos are coming from an intraday perspective. A lot of intraday algos are coming in. Even scalpers also, the people are trying to automate on scalping. So mostly they don't give any commitment to the positions, right? So basically now 5 minutes back they will trade long, another 10 minutes later they will be trading looking for a short opportunity. Basically they don't stick to their positions, they don't give strong commitment to their positions. Whereas the short-term traders, they give commitment to their positions for 3 to 10 days. Right? It could be an retail trader, or it could be an hedge fund. Even a hedge fund, some of the positions are short-term trading. Even I heard in Franklin Templeton, they are doing naked option buying kind of setups. Or some of the institutions, some of the hedge funds, they are also involved in short-term trading. Right, so basically they give commitment to a position. For example, when it comes to Nifty, you might find this pattern. Frequently in the markets, like in a consolidation zones, where market might be trading in a zone. This could be 10,700. This could be 10,700, and this could be 11,100. Let's say every time price moves to the extent, and the short-term sellers will be trying to sell the markets, and they'll be pushing the price down to the one of the extreme. So they might be giving this commitment for 3 to 5 days, where you'll be finding poor highs there, and some other short-term trading activity here, and some other short-term trading activity here. And again, once they reaches the one of the extreme, again they might push it back to the upper extreme. The buyers will take control, and the short-term buyers will push the market to the one of the extreme. Again, they might do this for some time before market breaks out or something. So basically, in a bigger swing, if something like an 300 point swing is a decent swing in the Nifty, if you're seeing that market is moving in a compressed 300 point band, most likely those zones could be dominated by the short-term traders, right? So as an on a day-to-day basis, 80% of the time we are going to deal with these players, short-term traders, scalpers, and intraday players. Whenever you are trying to do a transaction, 80% of the time your transaction will be mostly with short-term traders or scalpers or intraday players, and they are the one who will be dominating in the market most of the time, right? So whereas a long-term trader or an intermediate trader, their domination is not actively on day-to-day basis. They might be here and there adding some other positions, but they'll be taking dominance at their own reference levels. Probably the long-term trader, they might be watching a difference level, something like a 52-week high. So let's say people are here, what are the levels watched by the long-term players? So intermediate or long-term behavior. So they might not be interested at day high, day low. They might have a different reference level. Maybe they want to buy an 4-week break of 4-week high or low. They want to enter. They want to enter at 52-week high or 52-week low. They might be interested at 200-day moving average. Maybe the trading money which I'm talking about might be on a 5-minute time frame or a 10-minute time frame moving average, whereas the long-term players might be interested. Most of the long-term players, if you really understand, they track 200-day moving average on the daily charts or weekly charts. On daily or weekly charts, they might be tracking the 200-day moving averages. They also use Bollinger Bands, but they might be dealing on a daily time frame. In their own time frame, they might be dealing with that. Or if it's an all-time high, it all-time high or an all-time low, it garners attention. Or if it is coming at an multi-year high, or multi-month high, which will be combined with volume, which will be usually combined with volume. For example, when Reliance was trading sideways, sometime back during 2008, Reliance had a peak and it went down, and almost for 7 years, they're not doing anything. They are in a range. Markets are in a range for Reliance charts, right? But this is almost for 7 years. 7 years, they are in a range. And one of the 7 years, they've broken up with a huge volume. If you look at the volume perspective, the volume was relatively less. And when that breakout happens, this breakout happens with some 11% break. 11% break. It was a break of 7 years of volume. 7 years of volume got broken out with a significant move, 11% move with a huge chunk of volume. Those are the zones they'll be taking dominance. Otherwise, all these places they might be adding here and there, they might be adding on day-to-day basis, or they might be adding, removing. Some long-term activity will be happening here and there, but they are not dominating the market. They are not actively moving the market. But when they are taking the dominance, they will be moving the market to a different realm. They'll be moving the markets in a non-linear mode, so where you can see that a price moves to a different territory where new players kick into it. So it breaks the level when the long-term players are involved. So when they are bringing it to the new territory, it will be more players will be interested in trading these zones. There are more fresh money will be coming into the markets. They are the participants who never participated in the previous auctions. It's like they are the one who wait someone to kickstart the auction. The auction got kickstarted by someone, and now they value that there is something really going on in the market. So later they come and join in the auction, and then you will find a trend coming into the markets. So that's how the auction kickstarts when it comes to long term. But when they are giving commitment, they give a solid commitment for next 3 months or 6 months or 1 year, right? So, and they come at frequent intervals. It's not like when an institution is buying, at certain price level, they might be buying. Usually they don't buy at one level. They might be buying in an accumulation mode. They might bought in this zone, right? And later on, let's say one more event is happening. Let's say Brexit is happening. They might come and add up over here because they find a lot of liquidity there. So when they find institutions love liquidity, they love to add to the liquidity. So they come on, they'll be active on event days. When an event like Brexit is happening or some election results are happening, they might be come and observe all those things. Again, something like an demonetization happens, again, they add to it. And like something like a terrorist attack happens and the market crashes, they come and add to it. So those are the places they show their dominance. They'll not be active on day-to-day basis. Even if they are accumulating or distributing, they don't show their presence unless there are events like Brexit or demonetization, or the events like election results, Gujarat election results, or the recent Maharashtra election, Madhya Pradesh election results. So those are the results where you can find a good volume on those days. Most likely the institutional dominance are very much higher on those trading days, right? So those are days they take their dominance. Rest of the days we'll be dealing with mostly with trading money. Mostly trading money will be taking dominance over there, and very rarely they show that the long-term players will showing their presence. Usually you'll be able to identify in the form of volume and the way they are moving the markets, right? Otherwise, what we'll be looking mostly from the market profile is where the short-term activity is happening, where the intraday trading activity is happening. That's what we are mostly concerned about. So we are mostly concerned about where the intraday players are getting piled, where the short-term trading activity is getting piled. And we're not going to trade against short-term players every time, but we'll be mostly trading against the intraday players most of the times, right? And these two activities, you need a lot of other confirmation, a lot of other macro confirmations, or you have to combine with what is happening from the fundamental perspective. Is there any shift is happening? Mostly it will be realized in the form of volume, right? And the exchange classifies the market participants into 4 types. Our Indian markets clients usually involves retail clients, family offices, or even corporate bodies. Like Infosys, they have their own dealing desk, and the Reliance, they have their own dealing desk. Likewise, many corporate offices, they have their dealing desk. They also actively involved in the market activity, right? Not only retail clients, not only HNIs, ultra HNIs, everyone belongs to the clients. FIs are like foreign mutual funds or hedge funds, are mostly, they are in Indian markets, they call this an alternative investment markets, AIF. They're mostly a AIF, something like in Franklin Templeton, mostly global asset portfolio companies who want to deal in Indian markets. They register themselves as an FII or FPI, and so they will be mostly called as AIF. The AIF are the one who actively trades in futures as well. They are the one who are allowed to trade in futures. They have, AIF has multiple classes in India. So I'm not going to go detail into that, but they're just foreign mutual funds. They're foreign funds basically. And most of the foreign funds are macro funds, and some of them are long short funds, some of them are arbitrage funds, and some of them are option mispricing model funds even. And the DIs are nothing but domestic mutual funds. It could be pension funds, it could be insurance funds. So mostly they are like Sundaram mutual funds, or SBI mutual funds, those kinds of funds. They have a very little presence in future market as of now, because they are mostly using futures only as a hedging tool. They don't involve in any kind of speculative activities. Even the FIs, FIs and DIs and pros, they are not involved in much of the speculative activity, because they are mostly funds. They have a process to deal with that. Not every FIs is in speculators. So yes, some of them they do, but when it comes to DIs and pros, the numbers of speculation is very, very less. When it comes to index futures, when it comes to instruments like Nifty, Bank Nifty, they mostly do arbitrage, they mostly do hedging. FIs too, they might be interested in manipulating to some extent, and clients is where most of the speculation happens. Even if the FIs are speculating, they'll be protected with some sort of an hedges, and client is where most of the time they go without hedges or with hedges, right? So a lot of speculation happens from the client perspective, right? And they are the top volume. They are actively holding a major open interest in when it comes to index futures and Bank Nifty. Index futures like Nifty futures or Bank Nifty futures, clients hold mostly 42% of the open interest. 42% of the open interest, whereas the FIs, they hold closely 32 to 34% of the open interest in index Nifty, Bank Nifty. That means a greater fight happens between clients and FIs. DIs are very less. Their dominance in index futures and Bank Nifty futures is only 8%. Whereas Pro, they don't speculate much, but somewhere around 20 or 22 is what their rough estimate. Somewhere 22 to 24 is what you can expect. So this guy can go to 32 to 36%, and these figures can go to up to 42 to 46%. Month on month it changes, but these are the approximate figures from the recent data points. Right, so last 3-4 years of data points. Client dominance is very much when it comes to index futures. Right, when it comes to options, FIs and Pro actively engage in options. Clients also actively engage in options. So client does most of the volume. They are the top put writers in Indian markets. Clients are the top put writers. FIs are the top put buyers. They buy puts and they hedge their positions. And pros, they do both. Mostly they play with straddle strangles. Mostly they kind of hedged strategies, hedged option strategies. Mostly neutral option strategies is what they practice mostly. Right, so DIs, as I said, they don't speculate anywhere in derivatives. They mostly use is only as a hedging tool there. Okay, so what we can learn from here is that these two guys, they don't give a solid commitment. Probably these two people give commitment for a couple of days, ranging from 3 to 10 days. Whereas intermediate traders, they provide commitment up to 3 to 6 months. Long-term traders are the one who gives commitment more than a year, right? So they could be something like they are mostly institutions who are coming and holding and support. Maybe like something like in Singapore government won't stake in Bharti Airtel, or something like an IHH group. They have a holding in they have a holding in hospital ventures, and something like Mauritius based funds. They have some stakes in some mid cap stocks or large cap stocks. So they give solid commitment to the market when they are buying, right? So when they are buying and when the price is moving up, when there is any fall, they are the first one to come and support the market. They are the first one to come and support the market because the asset classes are breaking. So, and they have a billions of funds to manage. So money is not a matter to them. For them, if they have a sufficient liquidity in the back, they come and support the asset class. They won't allow the price to fall, no matter whatever the bad news is going on in the markets, right? So let's say, for example, something like an Axis Bank. Axis Bank is owned by some bigger investment funds. Maybe it could be managed by those funds will be owned by Morgan Stanley or some big corporate hedge funds. So they give commitment to that. Next time when the asset class falls, despite all the bad news, they are the one who's come and supported, because if they are not going to come and support their asset class, they're gonna they cannot turn faces to their clients saying that we lost the money, right? So they are the one who come and add to their positions at appropriate places. So long-term traders, they will not actively involve unless there is some sort of event is happening. Post the event or during the event, they come and accumulate. Like something like during Infosys, this was happening. Infosys was going in an uptrend, and all of a sudden, one of the day, it was in a bear market for some time. And Vishal Sikka, the CEO of the company, resigned, and there was a big crash. There was a 10% crash comes in. 10% crash comes in one of the day, and that day volume was it's spiky volume. If you see the volume was pretty spiky, and then next 2 days it was kind of a little bit of downtrend. From there onwards, it bottomed out, and in what Infosys seen is a massive rally from there. Almost 30-40% of rally is what's seen in Infi. And those are the places they come and support. When Vishal Sikka is resigning, some CFO is resigning, our CEO are resigning. Usually market tanks, and maybe some of the institutions used to add that see that as an opportunity to add to their positions, right? Just like that, they don't panic and exit because they behave rationally. And most of the long-term players, they take rational decisions. Long-term players and intermediate players, most of them are funds. 80% of them are funds, and they take rational decisions in the markets. So next comes the Roger diffusion of innovation bell curve. Probably you might hear it if you are in the software cycle industry. I mean, if you are developing any software or any technological product or any product in the markets, it goes through this innovation bell curve. Likewise, in markets also, we go through the different kinds of market players, and some of the players we call them as an innovators. Innovators are are the creative thinkers. They are the one who actually design the product which doesn't exist in the markets at all, right? So something like Apple, they innovated iPod, or they are the first one to revolutionize the smartphones. They're not the first one to invent the smartphones, but they are the first one to revolutionize the smartphones without any with a touchscreen functionality and without any keypads, right? So previously, if you look into during 2005-2006 period, you will be having every smartphones will have buttons. They are the first one to remove the buttons and completely get into and touch-based screens. So they are the innovators who come up with a new concept, new evolving concept, and that the percentage is 2.5%. Hardly people remembers those innovators, right? So because they are the very first one to innovate, nobody remembers Yahoo or nobody remembers AOL because they are the one who innovate search engines, right? So they're the first one to discover the search engines. Later comes the Google, they revolutionize. So they adapt. Probably we can say like Google as an early adapter. They're not innovators. Google is not an innovator when it comes to search engine. Maybe many things they on top of search engine they would have innovated many concepts on top of search engine. Whereas they are the early adopters when search engines are very new to the internet, and they are the very one to appreciate the innovators, and they adopt those principles. When it comes to markets, the innovators are the one who buys at the bottoms and sells at the market tops. Next comes the early adopters. They are the one who appreciate that the market has been topped out or bottomed out, and then they get caught to that trend. Right? They get caught to the trend, probably very early to the trend. Next comes the early majority. Early majority needs some sort of confirmation. They need some sort of breakouts. They'll be waiting for the breakouts, 1 day breakout or a 2 day breakout, or some sort of they'll be waiting for the consolidation to get broken out. So they need some consolidation that breakout is happening, and then they want to join the breakout. So they are mostly they need some element of confirmation. You look into the markets in any technological field, the early adopter is 13.5%, and early majority is where they need a clear trend to set up, then only they come and join. Late majority, once the trend got developed and then the trend is going on, they need a lot of confirmation. They need support from the news should be supporting. They need everything should be supporting. The analyst should be saying buy rating, and the GDP should be positive. Then only they'll come and buy. The inflation should be in appropriate manner. So they'll be looking for a lot of confirmation to take their trading decision. They call it as a late majority. They're often late to the party, and most of the time they chase the momentum. They are the one who chases the momentum in the markets. So it is like you might be seeing that trend. A trend will be initially, it will be slowly picking up. It picks a little bit faster, and last minute fast will be really high. So these complete fastness. Maybe I can show you Bitcoin charts. Like I can show you how the Bitcoin charts looks like. Bitcoin is a cryptocurrency which recently went boom last year, and then it also busted last year. I mean, 2017 period, it went into a boom, and 2018 it was completely bust. BTC USD, it's where the Bitcoin charts is all about. Okay, if I go to daily time frame, so you'll be able to watch how exponentially the chart is going on. So when exponentially the price is going on, it is mostly where the majority of the late majority, they joins the crowd. So this is where the late majority field, and finally it's where all the media channels talking about it. Every day they'll be talking about Bitcoin activity. Every day Bitcoin is moving up 4%, 5%, 10%, 20%. You'll be getting an active news alerts from the media channels. Media channels will be continuously engaged in those activities. That is where the majority, late majority, and the laggards join. And laggards are the one who are the final one to catch the top, and they are the last one to get out of the bottom. Right. So always laggards comes at the market top to buy, and the laggards always comes at the market bottom to sell. They are mostly long-term players who get caught. Not every time long-term players going to be successful, but as a late majority or a laggard buyers, they chase momentum. They chase only the momentum, and they at times, not at times, most of the times they get caught in the momentum because they just look into the price. Price is moving every day 5%, 10%. They go with the momentum. It is good, but at the same time, it is bad. In terms of time, it is bad. If you're chasing momentum, you chase the momentum and you get out of it. Chase the momentum, get out of it. But if you're always chasing the momentum and you want to be in a longer time frame, that's risky, especially if you know that you are in the late majority crowd, right? So most of the cases, it's going to be an devastating setups. What they'll be looking is they'll be looking for momentum. They'll be looking for excitement. They'll be looking for exotic price action movements is what they'll be mostly looking out for. And they are laggards at any market tops and any market bottoms. The innovators and the laggards meets. Innovators at the market bottom comes for a buy, whereas the laggards come for a sell at the market bottom. Whereas at the market tops, the innovators come for a sell, whereas the laggards come for the market buy. So they meet at the peaks and valleys in any market uptrend or a downtrend. Right. So as a market player, if you are not in innovator, at least you have to be in an innovator early adopter stage. So that is where the market profile and order flow focus you to put either on the innovating side or on the early adopter side. Right. Anyways, we'll dig deeper into it. Will be mostly you can you can cross compare the diffusion innovation model, which is done by Mr. Rogers. He got an Nobel Prize also for inventing this. You can cross compare market profile with you along with the diffusion bell curve, where you are exactly standing from the diffusion innovation of model point, and this model applicable to any kind of trading industry, not only to trading, it also applicable to software. If you're developing a software, who are your competitors, where you're standing, are you an early adopter, are you an innovator, are you a late majority? So what of software cycle you are in. And the point of control, we already talked about it. The center point is where we call that as an Paris point to do a business. But if any day, if you're seeing more than 10 TPOs, right, we call that as a prominent point of control. And in my term, if I'm using an Bell Ultimate Edition, I'll be getting a level saying that PPOC, POC, prominent point of control. That means if more than 10 activity or more than 11 or 12 activity happening, that means it's mostly done by short-term trading community. So the more people engaged over here are mostly, they are short-term traders. It's one of the way where you will be able to figure out what kind of trading activity is happening over there. So maybe if you look into my Nifty chart, you'll be seeing a lot of prominent point of control levels, which will tell me that I'm dealing with a lot of short-term players over here. Maybe I'll go to Nifty charts and I'll right click and I'll go back to my initial settings. That is 20 points, which is nothing but 1 point TPO. Right here, you'll be able to see that prominent point of control over here. They're nothing but automated reference line plots where the TPO is more than 10 activity. So if you go back and count the number of point of control over there, it is more than 10. That means that particular day I'm dealing with short-term sellers. They're mostly short-term sellers because, sorry, short-term buyers, because price went up on that day. Price went up on that day, and it's mostly short-term buyers. Letter A, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Almost 10 TPOs got traded over here. So more than 10 TPOs, it says that I'm dealing with short-term trading activity on that particular day. And most of the short-term buyers would have been having a stops over here. That is the context I will be able to derive from this information, right? So previously we learned that there is a stop loss below here, right? So previously we learned stop loss. The C, I, and J is mostly done by some mechanical traders. They are mostly short-term, mostly trading money. Trading money can be intraday players or short-term players, right? So, but the point of control, it clearly says that some short-term activity is involved over here. So price also end up on that day. Price ends up, but value was lower compared to previous day. Value was lower compared to previous day. If you see on 1st of Jan, the value was completely lower. So previous day value was here. Previous day value was here, and today's low was here. See that value was building lower. Value is building lower. I'm able to see an short-term trading activity. Price closed positive, right? And the stop loss is over here. All these are saying that short-term players went long, but with the stops in this band. So that's what I'll be able to gauge from this information. But more trading activity happens at the bottom. More players are interested at the bottom, and more stop loss built over here means who initiated the trades on the upper side are mostly short-term trading activity over there, which has a higher odds of revisiting back towards to test those liquidity zones, to test their stop levels. Right. So if the trading activity is more than 12 or 13, we call it as a very prominent point of control. But still, the software will be plotting as a PPOC. Right. So it doesn't matter. More than 10, we call it as a prominent point of control. Or only 12 or 13, it's called as a very prominent point of control. Often, prominent point of control acts like a magnet. Let's say this is the prominent point of control. Next day, what happens is price opens here, it goes and tests back. Or it opens here, it takes the day low, again it's coming back. My primary target is the point of control. So most of the time the point of control acts like a magnet, and one of the plays, if I am seeing a prominent point of control, price has the higher odds of revisiting those levels. If it is a prominent point of control or a very prominent point of control, it acts like a magnet, and it also shows the presence of the short-term players. If the prominent point of control shows the presence of short-term players. Right? Any questions on this prominent point of control? Any questions on prominent point of control?
Can you please explain why one would say that the short-term players are present at the prominent point of control? Sorry, I could not get it.
Okay, so let's say when more trading activity is happening in this band, when the TPO size is getting more than 10, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So when it comes to US markets, Jim Dalton rates, if it is more than 9, they call it as a prominent point of control. When it comes to Indian markets, we generally classify that as a 10 TPOs, right? So usually greater than 9, in US market, they call it as a prominent point of control. Whereas in Indian markets, we classify that 10 could be an appropriate place where we call as a prominent point of control. Now, why we have to call that as why the short-term players might come over there? That is your question, right?
Yes.
So when more trading activity is happening over there, the volumes also, you can find that more liquidity is happening in this band. When more liquidity is happening in this band, this is where the institutionals love to trade against those short-term players. Again, one of the places where what in the olden days, what they had done is that on the floor, Jim Dalton and Peter Steinmeier. Peter Steinmeier is the one who invented market profile. He patented market profile. And Jim Dalton, he personally took all his research materials. He paid even a sponsorship for his book as well. He took all his materials and he observed all these activities. So one of the things which he observed is that the two-way auction process impressed Jim Dalton, and he took it and he given a more meaningful to its dimension. So he also ran a discount brokerage. So whenever the large trading activity was happening from the floor, they realized that all these activity was done by the short-term trading community. So what Peter Steinmeier goes is that he goes physically go to the floor. He records this activity. Those days we don't have such kind of trading softwares. So he plot every 30-minute high and low, high and low. He keeps on plotting it. And then he watches the floor, he watches the noise in the markets, and then he tried to realize where the most of the trading activity was happening and who is responsible for that, right? So from the all these are in the books. So from the books, it says like the point of control, if it is getting more prominent a point of control is there, more the activity is done from the short-term trading community. That's what it's from the books.
Okay, thanks, sir.
Yeah. Otherwise, I don't have any other meaning to that. So it's mostly from the books, mostly from the learnings from Jim Dalton and Peter Steinmeier. Peter Steinmeier is the father of market profile, and Jim Dalton is the one who given the next dimension to the market profile. But that's an interesting question. Anyways, I'll try to explore more on that. So POC non-migration, right? So there are certain days what happens is that point of control would have been initially formed. Point of control would have been initially formed over here. You see that?
Hello.
AB, yeah.
Hello.
Yeah, tell me.
Hello.
I'm able to hear you. I'm able to hear you. Okay. Okay, anyways, I'm going to continue here. So the POC nion migration, right? The point of control builds over here initially, but the second half, what happens? There is a strong trending activity was happening, right? So not much of rotation. Price just keeps moving in one direction, and you know that point of control cannot migrate. It is a sign that we are dealing with late momentum buyers. That's how most of the late momentum buyers comes into the markets, right? So they chase momentum. They chase momentum. They come whenever the point of control, more activity happens in the first half, and lately price is migrating, but point of control is not migrating. We call them as a momentum buyers. They are mostly late majority or the laggards in the markets in most of the cases. And precisely if the point of control is not migrating and price is migrating, you have to record that activity, and that helps you to position yourself there. One of the places where you need to consider booking partial profits or complete profits over there. So these are the late momentum buyers. They are mostly, they watch the price. They'll be waiting for the breakout. The breakout happens, they pile on the breakouts in the late second half of the day. So they are mostly emotional. They chase price, they chase momentum. Usually, most of the times, they end up getting trapped, right? So maybe the very next day, market opens the gap down, and then it used to reverse back. So usually what happens is that they do one more balancing here, one more day of balancing. The day will be bullish, and next day will be some sort of an event, opens with a gap down, it breaks completely. There will be a trend reversal. So if point of control non-migration is happening at certain reference level, you need to give all your ears that maybe we might be nearing a swing top, or we might be one of the ways a market tops out or a bottoms out is via non-migration. Not every time markets are going to top out or bottom out using POC non-migration, but most of the major swing high or a major swing low, if it is showing POC non-migration, probably either we are very close to the top, or one maximum 1 or 2 days we will reverse from there. That kind of situation we are in, because now the market is in the hands of late majority or the laggards. So next comes, we talked about good high, good low, right? It's the same concept here. So a good high, a good low. So these are good high and good low. We call that as an excess low or an excess high. We also call that as a good high or good low. Whereas a poor low, this is a poor low because it's only having one tick at the lows, or it's a poor high because there are no ticks at the day's high. So we call that as an poor high. Also, we call it as an incomplete auction. We call it as a completed auction. If you're seeing an excess low, we call that as a completed auction. Even the high also, it's a kind of a completed auction. So it's kind of a good high. So these are the examples for good high and good low. And these are the examples for poor high, poor low and poor high. Right? And rally high, again an interesting pattern which helps you to take an positional long opportunity. Most of the times you might seen, usually these kind of rally high comes on Fridays. On Fridays there'll be an bearishness will be there in the market will be crashing, and second half what will be happening is that price lately, despite all the bearishness, despite all the global markets crashing, lately there'll be a minor uptrend. The end of the day, the tone will be negative for the day, but there'll be a rally high that serves as a crucial reference level for the Monday, right? So if you're finding a rally high, A rally high will be like it breaks and lately it recovers back, or it breaks, it recovers back, and then again it breaks. So these are the two ways a rally high can form, right? So when the rally high is forming, it's a reference. It is valid only for next day. So when the very next day the price is opening here and it moving up, point of control started building higher. That are the signs that this is a high confidence market. Even though price is trading inside the range, price is getting accepted above the rally high. That is why you'll be able to see that the point of control for the day, it started building above the rally high. It is a very good sign that there is a change in the market. Previously, yesterday's Friday's activity was down. We had a rally high, maybe because of some bad news came in the markets, or maybe some local, we had a local bad news or global bad news. But lately, despite all these negative news, market started accepting above the rally high. It's a very first clue to take a long monitor. Once you took a long, the next thing you have to do is you have to monitor for the continuation. That means when I say monitoring for the continuation, you have to check where the point of control is getting built. If they are not a serious buyers, what they do, they take up the rally high, they plunge back in, and activity will be building here. Again, they will crash, again activity will be building here. That day will look like a rejection, right? If it's a good buying, most of the rally high is there. They opens, let them open here or here, it doesn't matter. They immediately accepts, or at times they come up in the form of gap. They test the rally high, again they build activity higher, more activity comes here, more activity comes here. So no matter what, you'll be able to easily figure out how the acceptance is happening in the market. So you'll be able to judge whether this is a good buying market or not. Usually this is a good buying market. The opening itself, you get a clear-cut confirmation that the buying confidence is high. So you may to act fast really here. You may have to take a trade at the opening itself, and then you have to continue monitoring here because it's a rally high, right? So maybe I'll show you one of the rally high which happened in the market recently. It happened on Thursday. It's not a Friday rally high. Friday rally highs are very important to us. It's a signature trade as well. But this rally high in Nifty, it happens on 3rd of Jan. 3rd of Jan, you see here. So this rally high, price broken. It lately recovered, and again it fallen down. So it's something like this: price broken, there was a pullback followed by a market went down. A rally high can also come like this: market breaks, and then lately a recovery was there, not full recovery but a partial recovery, something like that. So but still the day would have been closed negative. All the global sentiment remains negative. The entire world could be negative. Maybe the US markets might be breaking down. So this particular day, the US markets went down crazily. This particular day, the US markets was down by 2%, 2.4%. Right? So almost 2.5% crash over here. The entire world was bearish, but we had a rally high over here. We had a rally high. That rally high still till today it is protected. With that, as long as the very next day, when this rally high is there, that acts like one of my confidence positions. So you see that what is happening here is that I want all your ears here because it's quite important setup. So I'll be putting a reference line saying that this is my rally high. This is my rally high. Text. Rally high. Okay. So previous day market closed over here around 10,720. And one of the reference, this reference line has been continuing from this double distribution balance. So the single print zones, over here, I'm continuing over here. It's still positionally, market took a support over there. You see that positionally, market took a support over there. it was plunging. It was trying to plunge below that. Every time it's trying to plunge below that, point of control is building above here. Initially, point of control was here. For a period of time, it was here, and later it migrated over here. That means I'm still not getting an acceptance below the downside, and I'm not getting an acceptance above on that particular day when the price went up. My point of control was completely formed over here. When the price went up, testing the rally high. Right? If it is a good buying, at least they might leave some single prints here, single prints, and then more activity happens over here. There'll be some single print zones will be left out there. But then instead that price went down, it does some sort of a mean reversion over there. That means price haven't accepted, price opening at the center, it tried to break the previous day low, it tried to break the single print zone level, but later on it's not able to succeed. It came back in, it tried to accept above the rally high, it got rejected there. Again, there was a mean reversion. Again, price closed very close to the rally high. And this rally high, the rally high which formed on 3rd of January, it's an intraday reference and it is valid only for one day. It's valid for that only for that particular day. And now it moves away. Now for the next day, I don't even consider that rally high. You're getting my point? The rally high is an intraday reference. I'll be using only for that particular day. The day is over. I'm not going to monitor that as a reference at all in the near future. So I'm done for the day. I'm done for the day. That is why if you see that I'm not positioned in any of the sites that particular day. Even though I was bullish in the markets, I'm neither went short, neither went long, because I know that point of control is developing at the center. Price broken the day low. They are not confident. If they are confident, more activity would have happened over here. That doesn't happen. It looks like initially it happened, but then later they got back in. That means the sellers who came down, they are not serious sellers. The sellers are not serious on that day. Okay, the sellers are not serious on that day. So they went up. They took the rally high. And they are not serious buyers also. So they went down again, because if they are serious buyers, activity would have been built higher, and that doesn't happen on that day. So there was a rollback, because most of the activity was almost formed over here. The point of control was shifted over here. So price mean reverted back towards the point of control. As I said, price acts like a magnet. It went down below that. So it was a tough trading day, but if you follow the process, you would have neither went long, you would have neither went short for the day. I mean, if you follow some order flow principles, you might be able to scalp some points, but from a profile perspective, it's a no trading day for that. These kinds of markets are really tough to digest and trade these kinds of market environments. You see the swing, it's initially they went up some 40-50 points. If you would have followed the price alone, you would have been mesmerized with the 40 points more initial up move, and then lately it went and took the day low. You would be thinking that market is breaking the day low. Oh my God! And then market again reverses back. You will be under the assumption that this market is going to be bullish. Again, it all of a sudden it falls 70, and then again all of a sudden it rises 70. As a humans, we are not designed to process all these complex informations, right? So what you can do is that better on that particular day, we have only two reference level. I kept it over there. One of the reference level, which is nothing but the previous day low, which is also the short-term reference level. So I kept this as a previous day low. My monitor was at previous day low, and another monitor I kept around rally high. So these are the two reference level I was watching. Markets are not doing anything there. It just moving back and forth. It's not showing any buyers are there. So initially the market opened inside the range. It tried to break the previous day low. 3 activity happened. They got back in with a sharp move. Again, activity started developing over here. They went taking the rally high. They're not able to take back. They again came back to take down the day low. They're not able to take back. They are ended again very close to the rally high, right? So that is why my view is that we got a view like So initially at the morning opening itself, we'll be able to say that low seller confidence around 9:53. This was my comment. Low, it's a low seller confidence. Sellers are not serious in the early morning. So they're not serious because the acceptance is not happening down below the previous day low. Every time price breaks the previous day low, they got back into the reference, right? And again, my comment is like when the market is about to close for the day, so it's good to go neutral and come back on Monday for a fresh opinion. I'm neither bullish or bearish because it's neither breaking both the sides, right? But likely to resume to be bullish towards Jan 1 high if situation are favorable from Monday onwards. Right? So from Monday onwards, something different is going to happen. We know that it's market is going to open gap up. I was positioned bullish in the markets, right? But at the same time, you also learn to appreciate that we are not getting into wrong trades, right? So if you follow the process, which I'm going to explain tomorrow, the high confidence, low confidence process, which we will talk about it in tomorrow's session, which will help you to avoid most of the unwanted bad trades. At least you will not get swirled into the volatility. Yeah, questions? Somebody is having a question here. Nitin.
Hello.
Yeah.
Sir, what I meant to say, generally, like I have seen like you just posted the comment in the Slack, and do you also recommend it like to the target levels also?
Yeah, I do. I do at times when I having a confidence that market should auction in this direction, I post the levels.
Okay, sir. Okay. Thank you.
Yeah. So it's like there are the places why I am seeing Jan first high soon. I would be explaining why I am seeing this levels. I give an explanation why I'm expecting Jan 1 high to be get tested, and why we are expecting the stop loss when the stop loss can be triggered. So I'll be posting my expectations also there. Yeah. Nitin, is that question your question answered?
Yes, sir. Yes, sir. Done, sir.
Okay.
Thank you.
Thank you. So rally highs, like how the rally highs are interested, the same wise the opposite is the pullback low. The pullback lows are something similar. Either there'll be an initial rally followed by a late pullback, or something like this. There'll be a rally, there'll be a pullback followed by again a rally. So both these lows, we call that as a pullback low, and both these lows are intraday reference level. Again, these reference levels are valid only for intraday. And if something has to change in the markets, right? So if something has to change in the markets, point of control has to accept below that, right? So pullback low, we have a very specific way of trading pullback lows. Like something like a good pullback low is like, will be forming like this. There'll be a strong rally followed by a strong reversal to almost, you will be seeing 75% of the retracement will be coming in. And the very next day market opens gap down and it starts showing high confidence, right? That is how good pullback low will be. Whereas the other pullback low, it will be a strong rally, probably not even 50% of the retracement. We call that as a pullback low, or there'll be a strong pullback low coming in, like something like this. These two are pullback lows, pullback lows. These are pretty tough to trade, but still one can make use of it. What market does is that these are the complex situations market throws you at this junction when there is no bigger retracement, when the retracement is only 45% or 50%, which you can see it from the chart itself that it is not a bigger retracement, or something like this. These kinds of retracements. So here it is a bigger retracement, right? So there is a good rally, a good retracement, and then market went up to the top. So in such kind of scenario, that will act like a support zone. The next day market opens here, this will act like a support zone. Market will be doing more activity over here. Lately, they might come and touch, and then they might rotate back there. So if at all, when you're dealing with a pullback lows, let's say initially if more activity was happening on the top, Initially, more activity was happening on the top, and lately, pullback low is going to broken. It's not a good break. So don't carry forward the emotions. Wait for the price to pull back above the previous pullback low and look for a contra trade over there. So pullback lows are meant for contra trades. At times, what happens is that price opens around the pullback lows. Price opens around the pullback low. Price opens inside the range. It breaks, again come back. Again, it will be doing some activity. More activity will be formed. The point of control will be formed. It breaks, again come back. So these are very tricky situations where you need to deal with pullback lows. My question, anybody has a question? Because it's generating a lot of background noise. Nitin, if you don't have any question, you can mute yourself. Okay, thank you. So the pullback lows are pretty complicated to trade, but when the pullback lows are understand that there is no easy giveaway when there is a pullback low. Okay, there will be easy giveaway only if you find a pullback low something like this. If you find a pullback low like this, and the very next day market opens here, straight away there is a drive, then this is where the change in trend comes. But whereas if the pullback low is coming up with a shallow retracement, if there is coming up with a shallow retracement, it will be mostly tough to trade, but the buyers will be still positioned on the long side. It will be like market opens here, right? Nothing happens, and then most of the activity will be formed initially. Most of the point of control will be formed initially. There will be an ABCD balancing. All in a sudden, market crashes. Even it could take but eventually they will come back again. They do something like this. It will be very tough to trade. These kinds of scenarios are tough to trade. Maybe you may plan to avoid these kinds of scenarios, but if you look emotionally, you may get trapped in this. Price will be plunging below the value area low. Price will be plunging below the value area low, where you need to take and trade over there, because already point of control is established at the over here. So pullback lows, these kinds of pullback lows are not easy giveaways. They don't break most of the time. It's hard to break those times. These are the places where maybe the Europe might be opening negative, or the all in a sudden US mini, the US market, which was positive, US futures are positive in the morning, which would all in a sudden, it went negative all in a sudden. Our market might be crashing, and lately the pullback, the rally comes, high comes, and everything restores back to normal. Again, US markets in the evening, again it opens positive again. So these are very confusing moments, but one thing you have to know that if there is a shallow retracement, there is no easy giveaway when it comes to pullback lows. Maybe one of the pullback lows, which I'm going to show now. Again, over here, so what we got here is a pullback low, right? So there is a downtrend. Again, there was a rally, there was a pullback low. So means there is no easy giveaway. This is what you can understand on Monday. So maybe the bias itself there, it changes positive. You know that there is no easy giveaway. Even market opens here, more activity happens over here. They come and test here. They will bounce, but there is no easy giveaway. If this pullback low has to form, it has to break, price has to do some bigger activity here, and then market has to move down. So pullback lows, they don't give easier downtrend. If it is an easier downtrend, the pullback low has to be something like this, right? So in that case, with a bigger last minute crash, we call that as a last minute crash, where the rally was there for most of the period, and last 45 minutes there will be a crash which will bring down more than 70% of the retracement. The rest of the day you'll be finding price. I mean, next day onwards, price easily breaks the day low or opens down below the previous day low. It maintains the high selling confidence. It goes with a high selling confidence. That is how we can use pullback lows, right? So in my trading experience, let it be stock futures, let it be index futures, pullback lows are tough to break unless it is a last minute sell-off. And some of the terminologies over here, here we call that as a balance market. Is like more activity happened, it's more rotations happen, more price rotations happens, right? So it kind of a coiling markets, we call as a balance market, or consolidation markets, where the TPO is getting widened at the point of control. More the widening it is happening, we call that as a balance market or a sideways markets. Whereas in market profile terms, we use a term called imbalance markets, where less and less rotations. Here there are less rotations followed by market moves. Again, there are less rotations over here. We call this an imbalance markets or a trending markets. So these are trending markets. So what kind of auction is going on? Is the auction is in balance mode or an imbalance mode, which is quite critical to know about it. Always market moves from imbalance mode to balance mode. So initially market takes a direction. Let's say Goldman Sachs, initially they want to, Goldman Sachs or Morgan Stanley, they want to buy for their clients. So they will push the market initially because there won't be much of liquidity at the open. So they will keep on buying all the buyers. All the whoever is willing to sell, they will eat everything. So market moves. Lately, they find the liquidity, right? So lately they find liquidity. So they will find more sellers for their buying. So auction will get into consolidation. We'll be seeing a balanced auction coming in, and once all the liquidity is over, again they will do the ramp up. Again, you will see that buying activity happens in the market. That's how the institutions play the game. That is where you see that rally highs. That is why you see the rally highs. So initially the Goldman Sachs might be buying, or the institutions will be buying, where the liquidity is very less. They eat out all the liquidity, and during middle of the day they will do some of the inventory corrections. They will cut down. They might be getting long to too long, so they cut some of their positions here. Some of their positions here. Again, they start ramping up positions again. Again, they pile up the inventory here. They dismantle some of the inventory here. Again, they pile up the inventory over here. That's how most of the institutions does. That is why you get the rally highs. That's the same case where you get the pullback lows also. So this is an example for pullback low. Whereas a rally high will be something like this. Institutional selling is happening. We will be getting a rally high over here. So rally high, there is no rally low, there is no pullback high. So it is always a rally high and pullback lows. It's only rally high and pullback lows, nothing else. Got it? So these are the two recommended books. One of the book is from James Dalton. Again, this is the most recommended books for the advanced users, not for the beginners. If you're a beginner, you can start with the Peter Stadelmayer markets on markets. Stadelmayer himself not using market profile these days because he traded during most of his trades has been done during non-electronic era, right? So whereas Jim Dalton is where he took all his research materials and then he given a new dimension how to trade in electronic markets. The same concepts he developed for electronic markets, and most of the principles are adapted from Peter Steinmeier, but still he removed some of the old classical things like initial balance. He removed some of the things like open drive, open test drive. If you see Jim Dalton's books, you don't find that classical features. Anyways, we'll be discussing those classical features as well. But whatever we are dealing, the market confidence, which is nothing but the subset of the open types. Okay, maybe in general terms, this is for advanced users. This is for advanced users, and this is for basic users. Okay, so basic users, and this is for advanced users. If you want to know about the market better, detail, how the behavior of trading happens, you have to go about this. If you want to know the basics of point of control, value area, minus development, how the activity happens in the markets, you can start with the Peter Steinmeier's way. It's like something like he's an innovator. Stadelmeier is an innovator here, and Jim Dalton is the early adopter over here. And this has been invented during 1985. So hardly we've been traveled from there 30, 40 years so far, right? So, but lately, not much of softwares until 2000, 2005 onwards. 2005 onwards, not many market profile tools started kicking in, and order flow kinds of tools started kicking in from 2012 onwards. So from the usage side, still we are in the early adopter stage. Do I have a soft copy of this book? I don't. I mean, I have a hard copy of this book, but I don't have the soft copy of this book. Okay. Anyways, or you can also go through. What I can share you is there is an CBOT book which is there with me. It's already publicly available from the CBOT website itself. So under TradeZilla 2.0, I can share this CBOT market profile. It's the same thing, more or less. It's a public material available in the internet as well. So I can share you this in the Slack. So you can download from the Slack. You can go back to Slack and download this copy. Almost 12 MB of, it gives you the basics of how the market auction happens in the market, right? It doesn't talk about entry points or exit points, but if you are new to market profile, if you want to know about what is value area, what is the importance of point of control, what does a point of control migrate means, what does it means on the floor trading days, how they evaluated on all those things, how the short-term players behave, how the long-term players behave. All these behavioral aspects are explained in this book, right? So it doesn't discuss about any trading strategies, but these are the primary basic requirement to develop your own trading strategies on top of this. Like these are the core fundamentals. It's your core thing. On top of that, we will be developing trading strategies on top of it. Right, so you can go and download from the Slack. If you haven't onboard, I would deeply recommend you to onboard onto Slack. Okay, so let's come back again. We can take questions. Otherwise, we can take a short break, a 15-minute break, and then we'll resume again by 3:30.
Rajendran, I have a question around what is the significance of having 30-minute time frame.
Exactly.
I missed it in case you have already spoken.
Yeah, no, I was asking for that question. Now it's good that you came back with a question. So there is a control which I can use in the software, like by default, if I right click, I'll go to indicators. So there is a control over here. It says like TPO size. By default, it's 30 minutes. I can also set it as a 15-minute. By changing the control, what you will get is more number of letters. Every 15 minutes, you're going to get a letter. Means instead of 13 letters in a day, you will get 26 letters, right? But the distribution will remain the same. The distribution will remain the same. You will not get any additional information. What you will be getting is the same information, but with more number of letters. It's the same distribution. Ideally, it's the same distribution. It's the same distribution. Probably instead of 10 point of control, you will get 20 point of control, right? So, or instead of 4 point of control, you will get 20 point of control. But the thing is same. But I met Jim Dalton in a traders conference in Bangkok. We also asked the same question, Jim. Have you ever tried with a 15-minute time frame or a 30-minute time frame? He said, like, we experimented with many things, 10 minutes, 20 minutes, 30 minutes. 15 minutes. Finally, we thought like 30 minutes is okay to evaluate the trader's activity. I don't think for an intraday player, we don't need any other time frame to practice. So what they said is that we done enough homework. Finally, we found out that the 30-minute is optimal, which is okay to record the market information. Anyways, since you're going to get one profile in a day, it doesn't matter. You'll get the same distribution. Everything remains the same. Probably the 30-minute reveals better and optimal information compared to any other time frame. That's what he responded when I asked the same question to Jim. So I'll right click and I'll revert back to I'll go to indicators and I'll use the standard setting. If you use any market profile tool, the basic settings, what they will be having is the 30-minute time frame charts. It's not 30-minute charts. It's basically in a day, only one distribution will be there. So This is what you'll be able to control. So in a day, only one distribution will be there. Or maybe if you want to split into 2 profiles in a day, you have to use minute, and you have to say like every 300 minutes you build me a distribution. So means every 5 hours or so you will be getting a distribution. In a day, a days of activity will be split into two different distributions. In such a case, you can go with a 15-minute. In such a case, you can go with a 15-minute. Means in such a case, it makes sense. If in a day, if you want to split into 2 profiles, but do I do like that? I don't trade like that.
Yeah, thanks, understand.
Yeah. But always I go with the standard practices. Initially we tried, we are not able to figure out anything out of it. So we stick to standard setups here.
And Rajendrana, how about say these are index on Nifty or Bank Nifty, but on stocks, does it work equally well for say large cap, mid cap, or small stocks, or because of the liquid nature of say
So
some
what
stocks?
Jim, we also put out the same question to Jim. The response from the Jim was like he used to trade real estate using market profile. He used to record all the real estate pricing activities, and he traded real estates. So it doesn't matter whether what kind of time frame player you are. If you are a long-term player, you can still use market profile information. If you are an intraday player, you can use market profile information. But it is always a good practice to look into high liquid instruments rather than sticking to a low illiquid instruments. Low illiquid instruments, you never know when the long-term player will come, and mostly it will be manipulated. So it's better to avoid illiquid segments and focus only on the liquid segments.
Thanks, understood.
Yeah. Any other questions? Okay, if there are no questions, then we can take a short break and we'll resume back by 15 minutes from here. That means.
Hello.
Yeah. Yeah, please go ahead with your question.
Yeah, Rajendra, Rohit here. This is for the rally high.
Yeah.
Only at the end of the session, we will come to know whether it was a rally high. What has.
Yeah, by end of the day, you'll come to know it's a rally high. We don't predict whether the day could be a rally high or not, whether the day could be a pullback or not. Only end of the day, you'll come to know that this day is a rally high. Or probably very close to the, near to the end of the day, you come to know that day is a rally high or a pullback.
Okay, fine. Thank you.
Yeah. Fine then, we get back by 15:35, right? So we'll take a break and get back by 15:35 p.m. That's a 15-minute break, and we'll get back. And I'll take the other questions which are coming over there. I'll be talking about that as well. I'm back here. So just give me a quick confirmation. Is the audio and video quality is good so that we can start with the session?
Yes, we are able to hear you.
Okay, great. So before getting into the session, I just want to have a quick announcement there. So today's morning video has been uploaded in this portal. You need credentials to access it. Right, so already the credentials would have been shared to you over the mail, the login credentials. If you haven't got any credentials, if the credentials are not working, connect with my support team. My support team, you can able to access them at 95351334445. And they'll be available from 9 a.m. to 6 p.m. Monday to Saturday. Right, so Monday to Saturday they'll be available if you are facing any login issues. So otherwise you'll be able to access this. Right. Here is the link here. I also shared in the mail. In the mail, the very first link is the premium recorded webinars, TradeZilla 2.0, Jan 2019 edition, right? So when you are accessing the webinar, it will be ask you for the login credentials and passwords. So once you sign up with then your login credentials, you should be able to access the morning recorded videos. And once the day is over, the current video session will also get uploaded over here. So you'll be able to see those recorded videos. And this access will be there for next 1 year. And also, I also shared in the Slack all the past recorded videos as well. Probably you also got the same as in your mail as well. So all these are past recorded videos, right, where we covered most of the same topics there. Of course, every new TradeZilla, we explored newer concept, we discussed newer strategies. So some new strategies are introduced in the recent webinar. So always it is requested to go through the recent webinar links, right? So, and TradeZilla 2.0 starts from November 2018 onwards, and we are in the second edition of TradeZilla 2.0, where there was this is where we started seeing a market profile in an we created a framework which used to see market profile in a very objective manner. And that's it. You can use the same link. What are the videos which I am going to post? What are the videos which we are, what are the webinars we are going to do in entire January and February month? Every video will be available in this link. So keep a bookmark this link. Right, and other than that, you will get access to the, if you go to market calls, there will be a link for market profile. Click on that market profile where you'll be able to get access to market profile, all the premium webinars, all the past webinars, all the community webinars which we have done, are some of the signature trades which we observed. Some of them are articles, some of them are videos, some of them are webinars. Some of them are trade setups, some of them are signature trade setups, which you'll be able to access it for the next 1 year, right? So market profile tutorial on stealth auction, all these are premium tutorials and articles and webinars and workshop links. So make use of this information. At the same time, you'll also be able to access under the order flow section. Under the order flow section, whatever we covered under the order flow, what are the webinars we done on order flow, you'll be able to access all those past recordings as well, right? Now coming back to the topic. So let's take market profile nuances and references. So some of them are intraday references. We've seen that rally high and pullback lows are intraday references, and it is valid for only 1 day. So likewise, the previous day high, previous day low, multi-day high, multi-day low, previous week high, previous week low, and half back unchanged and weaker high or weaker low. All these belongs to intraday references. That will be valid only for that day, and next day onwards we'll be moving to different references. We don't use that references anymore once the day ends. Right. Likewise, we also classified short-term references, which tomorrow we are going to have a deeper section on this, where we have a different sections: P-shaped balance, B-shaped balance, spike references, double distribution or a triple distribution references. Prominent point of control is a short-term reference. It's not an intraday reference. It's a short-term reference. And something like a failed auction. And this reference is also a short-term reference, but it is valid only for 3+5 days. Again, G2, G3, these are not part of classical market profile, but these are based upon our own observations at market calls. So these are proprietary patterns of market calls, where the G2, G3 highs and lows are again short-term references, but these references are valid only for T+2 days. And that tells about the market a lot, where we'll be using for high probability trend reversals, we'll be using G2, G3 lows. We also use G2 to find out whether it's a major market top or not, or if whether the G3, which is coming at a major swing high, is it a top or not, is what we'll be able to evaluate using G2, G3. We have a very good fan followership for G2, G3, so don't miss this section. And probably we'll be talking in a couple of days, if not today, right? So if today we'll try to cover it, if not, we'll try to cover tomorrow early morning, we'll try to cover this G2, G3. And gaps, all these are short-term references, means as long as the reference are not accepted, as long as the point of control is not get built above that, we will not remove that reference, right? So all these references, the P-shape balance, P-shape balance is like profile, which is coming like an P-shape. Okay, anyways, we'll talk about it. Not at this is not appropriate time to talk about it. First, we look into the references one by one, right? We looked into the rally high references. So this is again one of the Friday rally high. One of the example you can see here. If you look very carefully, you can see multiple observation on May 30th. This is May futures. This is during 2016. 2016. On 2016, you can find some weird activity which was happening around there. If you look into this activity, you see that B and C are exactly same. The letter D high was just 1 point below. The letter E high was 1 point above, and letter F was 1 point below. So a lot of crowded activity happens over here. That means some kind of stops got built over there. So what you can infer from here is that some stops built in this band, because it's getting very mechanical. Letter B and C are exactly same. Letter B and C, I'm repeat again. Letter B and C are exactly same. Compared to B and C, letter D is 1 tick lower. And compared to B and C, letter E was 1 point higher, and letter F was 1 point lower. So all these are pointing to some sort of an intraday trading activity or short-term trading activity. Trading money is involved over there. That's what you can understand at that point. At that point, what you can understand is that trading money is involved over there. So some stops would have been built above this reference. Right. Next comes lately the G drops. You see that the G drops. It took the previous day low. But you see that the point of control for that day is built over here. As I said, point of control acts like a magnet, right? So point of control acts like a magnet. When price is lately plunging down below the previous day low, price is also coming down below the value area. Value area was by the time it was here. Price plunges below the value area, mostly emotional sellers. Usually price rotates back to the point of control. Right? Lately, price also rotated back to the point of control because more activity happens over here. And lately, because of news, if there is any sell-off is happening and it is taking the previous day low and the price is coming back, it's mostly the emotional seller trap. It's most likely an emotional seller trap. Usually, it follows towards the point of control. Point of control will be the primary target for that particular day. So that's how when weaker sell-off happens in the markets. As I said, mostly you'll be seeing some activity here. Lately, a drop comes. It takes the day low, but eventually it pulls back, and immediately they started slowly moving towards the point of control. So that's what precisely happened over here. And if you look into this information, there was a drop followed by a late rally high. There's a late rally high. So if there is a drop and there is a late rally high and price closing exactly at the point of control, we also call this as a 45-degree line. We also call this as a 45-degree line, which what it says is that usually the players who are selling below the value area low are mostly getting trapped. They are mostly weaker hand short sellers are getting trapped for that particular day. That's what it means. And the 45-degree line, again, it's an indication that it's an indication that there is a trap for these sellers. All the sellers got trapped on that particular day. And you notice again, if you notice clearly again, these 3 points, again, the letters are exactly same. The letter G, L, and M, exactly 1 point, not even 1 point difference. Selling happens at G period, selling exactly happens at L period, selling happens exactly at the M period. So all these are weaker hand players, and markets also forms and rally high. If you look on the next day's activity, the next day's activity was slightly interesting here. So we got a rally high. Of course, this is not a rally high. This is not a rally high, but this is a rally high. So ignore this point. So this is a rally high. Price went down, and lately there was a pullback, but stops got formed over here. These stops got formed in this band, and stops got formed in this band, right? So you see that all these letters are having almost equal places. So 2 stops formed in this band. Next day, price opens here. not much of volume trade over here. There was a couple of trades happens over here. Next trade was again back over here. So kind of a fake tick. We call that as a fake tick, which you can often find in Bank Nifty, and in Nifty you can find very rarely. But this particular day, that there was no much of volume happened over here. The very market opens, and it was like a tick, and then the next trade it was started trading back over here. The market opened exactly at the place where you get this G, L, and M period where the stops is there. Market started auctioning lower. You see that you got an ABCD also. ABCD is where most of your point of control is getting established over there. And see that at price going down and down and down. Still it is at trading below the previous day low. It took down the day low and got back in. That is a poor way of selling, you know that, because most of the trading activity was, by that time it was around over here. So when it breaks the day low, it got back in. That is a kind of an, it's not a serious selling. It's not a serious selling at all. If it's serious selling, what happens? They will break and then they do more activity on the downside and they'll go down. But instead, if that is not happening, instead price got back into this range. And you know that there are many things you can notice over here. So a lot of weaker hands got over here. A lot of stops are built over here. Opening is also at the same price. You notice the letter B. The letter B is also exactly at the open. So again and again, mechanical selling is happening over here. Price selling exactly from the open. It's trading money, so it does that. Price, the letter B, the selling is happening exactly from the today's open. So today's open is also a reference where trading money plays there. So some sort of trading money is involved. Over here. Some sort of trading money is involved here. If you think very carefully, all the stops are placed above here. Then when they try to break the day low and got back into the range, that is a quick conclusion that this day is not going to be an one of the best zones to look for an long setup, because it's not a good selling at all. If it was a good selling, they would have been straight away went down. Instead of that, what happened here is that they got back into the range, they got to the point of control, and now what they're doing is a stop hunting. So it comes in the form of a short squeeze. And these kinds of patterns, you can precisely expect why the price, you know precisely why the price has to come back over here and why the price has to come back and do the short squeeze activity. And you know because of what kind of players you are dealing over there. You are dealing mostly with weaker hands here. And at the open, at the letter B period, at the halfback, you see that it's a halfback, it's a center trade location. The yellow color line which you're seeing over here is the halfback line, which is nothing but high plus low divided by 2. High plus low divided by 2. That's nothing but the center point of the range. So price is selling exactly from the center point of the range. And again, they're most likely trading money does again there. When you're spotting again and again trading activity, which is mostly done by the trading money, they are most likely to get revisited. So you know that this is one of the point where you combining all this information in the sense there is one weaker zone here, another weaker zone here, and despite that markets are falling, but point of control is getting like in the ABCD over here. Already 4 activity got happened over here, and almost 4 activity got happened over here. Right? So when 4 TPOs here, 4 TPOs here, 4 TPOs here, the odds are for this particular day, the odds are there that point of control is going to be in this zone, right? So what you have to do is that you have to wait for the if you're looking for an uptrend, you need to wait for the market to change, right? Or if you're already in the trade, what you have to do is that you have to wait for the point of control should not shift at all, right? So one of the place, what I can say is that when the price breaks and got back in, that is a sign of they are not serious sellers. A serious sellers will not move the market in this way. A serious sellers will be like, they would have opened here, they break him at the opening itself, or they may come 1 or 2 times and then they will start doing activity lower, and that's how a serious selling will looks like. If you from here onwards, if you started looking into market profile, one of the things you have to evaluate is this selling is a serious selling, or is this not a serious selling at all? So going with our rules, it is not a serious selling at all. In fact, it's one of the good trade location to look for your intraday longs, and precisely the first target is towards the point of control, that is the ABCD balancing, and second one is go and get the stops at the half back, and second one is again one more stops at the half back. So that's what the rally high is, the rally which is coming in the market, which has a precise meaning why the sell-off is meaningless and why the short squeeze has to happen in the markets. Right? Probably if you look into the trend or indicator doesn't give you such kind of context why the short covering has to come over here. But whereas when you're looking deeply in those subtle information, you get why this short cover, you'll be able to frame why the short covering has to come. Right? Maybe initially you may not be able to do it, but once you started seeing information and you started practicing repeatedly, you'll be able to figure out why the short squeeze has to happen, and precisely when it could happen and how long you have to wait for that to happen, right? So that's what rather than jumping into conclusion at the opening itself, you'll be learning to wait for your right moment to set up. And next comes the pullback. We already talked about the pullback lows, so let's talk about poor highs or poor lows. Poor highs and poor lows are I would say that it's kind of an unfinished business. It's a poor way of auctioning, right? So it's nothing but an what happens is here is that generally, let's say this is 10,700. This is what the current scenario which was happening here, 10,700 and 10,000, 11,000. So let's say when the market is going down, one of the day you're getting in poor low here, poor low. That means short-term buyers are taking control in the market. That's what we said in the morning, right? Poor low is where the short-term buyer comes, and poor high, if it is forming at the edges, it's an indication that short-term players are in control. Short-term buyers are in control. If you're seeing in poor high, that is not a good auction at all. That is not a good auction at all. Maybe price will get revisited over there. So it's one form of an exhaustion. It's one form of an exhaustion. And we call that as an unsecured low because it is not a properly auctioned market. So price again come back to revisit those price level to complete the auction. That poor high and poor lows are responsible for one of the ways where we say inventory is getting long too long, or inventory is getting short to too short. So if the inventory is of one side of the inventory is getting long, generally it results in the form of a poor high or a poor low, and all of a sudden there will be a simple U-turn coming in the markets. So when you are looking into the charts from the chart perspective, it will be going like this. So you'll be seeing in this example, you can see a poor high where there is only one TP at the tails. Again, there is one more poor high. There's one more TP at the tails. There's one more poor high here where there are no TPOs at the tails at all. Right, so there are no TPOs at the tails at all here. And one another example here. It's an AB poor low. It's an AB poor low. AB poor lows are very much interesting because the poor lows formed at the initial balance itself. If the poor low is formed at the initial balance itself and it is not cleared for the day, then the odds of coming and clearing faster are very, very higher. So probably this reference has the odds of clearing within less than a week or the very next day or 1 or 2 days. So if you are seeing in poor low and price is mean reverting back towards those AB poor low, it has a tremendous odds of revisiting back. So when there is a AB poor low, market gets cleared faster. Even though it's a bullish auction, now it is putting in a greater trading opportunity to mean revert towards 7,905. All you have to do is that You see a poor low and wait for the price to move away from the poor low, and you trade against the poor low, which is coming at the initial balance. It means the letter A and B, letter A and B period. Okay, maybe I can show you a couple of poor lows here. Recently, it happened in HDFC Bank. Let me check if I'm able to pull out HDFC Bank or not. I think last month there was HDFC Bank has, last month or November month, we had an poor low. So I'll go to indicators. Make it as 50 paise. And there was AB poor low. There is one AB poor low over here. That is still in reference here. You see the AB poor low. If you look at the AB poor low, only AB poor low has an exception of it can have up to 2 TPOs at the bottom. Maybe I'll zoom a bit and I'll show you. These are reference levels. So maybe this is a short-term reference. You need to carry forward. 2042 can be anticipated. So one of the reference which similar AB poor low was there around November month. Around 2000 levels. Oh, I don't have enough data point. So we have only one AB poor low left. So that is at 2040. So price usually come and revisit in less than a month. So the AB poor low, usually price comes, it goes away. It comes to indices, it usually comes and revisit within 2 or 3 days. It comes and revisits, but when it comes to stocks, it can go up to 80 to 90% of the time. The price move away from the AB poor low for 20 to 25 trading days, 20 to 25 trading days maximum, right? So I'm talking about maximum numbers, and then eventually they will revisit back. So there is one AB poor low. So in my case, automatically it draws and reference automatically it recognizes, and then it draws those activity, because these AB poor low, you need to set an optimal information. So if you set the optimal information, then only the AB poor low makes sense. Otherwise, it doesn't make sense if you're going to set a higher TPO size. Right. So probably the positionally still the focus in HDFC Bank is towards this 2040. Generally, market revisits back because it's a poorly auctioned points. Compared to poor lows, poor highs, AB poor low clears faster. So AB poor low, fading the AB poor low is one of the strategy we follow, but we don't try to fade poor highs or poor lows. Generally, poor high, poor low itself, it gets faded, but not all the poor highs, poor lows. But most of the AB poor highs, most of the AB poor lows gets faded, and that is one of our trading strategy. I like to play Nifty, Bank Nifty, poor highs, poor lows. I also like to fade AB poor highs or poor lows when it comes to Nifty 50 instruments, right? So this is one critical reference level you have to watch out for if there is an AB poor low is there. Okay, maybe I'll share you this charts for your reference. You can later make use of this. So to save the charts, all you have to do is you do Control S. Automatically it mentions what time, what date you are taking the screenshot, right? So 4 o'clock we are taking the screenshots now, and save it and come back to Slack. and post the charts here so that other people also make use of what your observations. So we are looking into HDFC Bank AB power low. HDFC Bank power lows. Okay. So to summarize, poor low or poor high are short-term references. Short-term references. They're not intraday references. They are short-term references, and it indicates incomplete auction. Most of the times, poor high or poor low revisit back, but we don't trade. We don't fade poor high or poor lows, because at times it will be tricky. Not every, in a sideways market, all the poor highs and poor lows will be cleared. In a trending markets, it may leave the poor highs, poor lows. You'll be missing a lot many good opportunities in the market. So fading the poor high and poor low alone is not a strategy. We have a strategy for poor highs and poor lows. We talk about it. It's called exponential poor highs and poor lows. That we faded. But because there is a one poor high, because there is a two poor high, we don't fade the markets. And but if it is an AB poor high, or poor low, and the market is deviating, markets deviate much from the AB poor high or poor low, that will be your primary target for revisit. Right? So revisit will be the primary target for your revisit, and anywhere it for index revisit usually happens. In 1 or 3 trading days, less than 1 or 2 3 trading days. I would say that it happens only once in Nifty. It extended for 20 trading days, but then it cleared. But when it comes to stocks, it can anywhere between 1 to 20, 25, 1 to 20, any maximum of 20 to 25 trading days. It can extend trading days, but eventually we've seen price comes and revisit those zones, right? So most of the time it comes and revisit back AB poor highs. So in a short summary, AB poor high or poor lows have a faster revisit than poor high or poor low or poor lows, right? So
sorry to travel. Quick question.
yeah.
So this AB poor high low, this is based on empirical evidence, or there is some theory behind it, auction theory or what?
No, this is based on empirical evidence. We are monitoring for the past couple of years, and couple of months, and we are seeing it again and again revisiting back. So what we have done is that I had coded in AmiBlooker also. I done a strategy on top of this. We done a back testing. The results are superior results. So it revisits back again and again and again.
So understand, but what it means that the auction process is not completed. The price discovery.
Yes. The auction process is not completed. So price go revisit back to complete the auction. And that is a short-term reference, and that reference will be valid as long as that level is not touched.
So just one more question, sir.
Yeah.
Is there any strategy you are going to share, sir?
I'm going to talk about a lot of strategies.
Okay, sir.
And prior to that, we need to discuss all this without knowing rally highs, without knowing pullback lows, without knowing poor highs, poor lows. We cannot discuss strategy. First, you need to understand that. Definitely, we want to talk about a hell of a lot of strategies, right? So,
okay, sir.
Always it's not going to one information I'm going to talk about it. Whatever we are going to see is a sequence of information. What I am trying to do is that how you can what is the meaning of each and every information, So when those informations are showing up on your screen, how you can take a combined decision, how you can interpret all those decisions, and how you can prepare yourself when these informations are showing up, right? Okay, so maybe if you are interested in strategies, like this is one of the strategies, like you might find this, like one of the day the price opens gap up and the price is coming and testing this at the B period. You see that the B period lows, you are seeing that it's a half back of the previous day. Half back is nothing but high plus low divided by 2. So high, previous day high, previous day low, and divided by 2, you get a center point. And when the price is coming and touching exactly at the center point, right? And price started one time framing against the markets. So you see that price comes exactly to the tick and it moves away. One of the places where intraday players will initiate a trades over there, where you'll be able to fade those players as well. You'll be able to use that as your primary targets to do a mean reversion trades. So halfback, who are initiating trades at halfback are again nothing but trading money. Next comes a weaker low. You might find these kinds of weaker lows many places, the BC or GH over there. So like one of the examples which I shown, the weaker low are when it comes to Nifty futures. When it comes to Nifty futures, we talked about this weaker low here. It's a weaker low. This is where the stops. We got to stop here, right? The C and I and J, we call that as a weaker low. That's what precisely a stop is getting built over there. So that is one of our target location. That is our target location. You have to keep it in mind. Always weaker high, weaker lows are a target location. Whenever the price moves away from that, that will become your primary target locations. Next comes anomalies. Anomalies are interesting setups, which helps you to avoid emotional trading activity. It helps you to assess how emotional a market is, right? So it says like, it talks about the profile distribution structure. For example, you look into this example here, right? So you think a profile as a building. This is one of the strategy. I would say that this is one of the strategy, and this strategy works really beautiful. And recently, last Friday, the same strategy, if you would have applied in Nifty or Bank Nifty, you would have been able to get some long opportunity there. First, I'll explain what exactly is this. Then I'll go back and take the Nifty and Bank Nifty charts, how precisely it happened, and what was our observation in Slack, right? So you see that there is a gaps in between the profile. You think about a building which is having a gaps. More the gaps you are able to spot. So there are a lot of gaps here, there are a lot of gaps here, there are a lot of gaps here. That is the gaps in between the profile. So there is one gap here, two gap here, and three gaps over here. If whenever you're finding more than 3 gaps or 4 gaps or 5 gaps, it shows that that particular day is dealt with emotional sellers. Maybe Nifty would have went down 100 points down or 150 points down, but when you find lot many anomalies, these decision has been taken down by the sellers are getting more and more emotional on that day. So when you are finding more anomalies, market usually tends to repair all those anomalies. Whenever I say repair or revisit, price comes and touches those levels. So for example, let me show you an poor structure. We call that as a poor structure as well. So this is look into the activity on 3rd of January. If you look into the activity of 3rd of January, right? So you can find such kind of gaps here. So this is one gap, second gap, third gap, fourth gap, fifth gap, sixth gap. So these kinds of 6 gaps are very, very non-frequent. It's not very frequent, right? So if it is more than 3, I mean 4 or 5 or 6, we call it as a poor structure, which usually repairs back most of the anomalies. You see that the price on that particular day repairs most of the anomalies. If you look on Bank Nifty as well, so maybe the Bank Nifty I have to reset the settings. The settings I primarily use is 20-point TPO, that is 1-point TPO in Bank Nifty. I'm using the optimal information here, otherwise I will miss anomalies again. So I don't want to miss anomalies. I don't want to miss single prints. So that is one of the reason I'm using optimal information. So you can see this particular date, 3rd of Jan. 3rd of Jan, you can see here, price took a plunge, right? Price took a plunge overall for that day. But if you look into the anomalies, 1, 2, 3, and 4, and 5. So total 5 anomalies over here. We call that as a poor structure. So that means it's an emotional selling. When emotional selling is happening in the markets, you have to be aware about that. The entire global markets are crashing. And if you look pretty carefully, that day Dow Jones crashed. The very next day Nikkei crashed. Nikkei crashed almost 3%. Hang Seng was down. Chinese market was down. Every other market was down. Despite that, market opened up, it went downside, and it went upside. It repaired all the anomalies in one shot. It repaired all those anomalies in one shot. So anomalies are, when you're seeing anomalies, one of the good place where if you are already in chart, you can do a partial profit booking, or you can wait for the opportunity to fade those anomalies. The very next day, you can position yourself to fade all those anomalies. So our observation in the Slack was something like that. There is an anomaly is there. So one of we are holding a short, and by the time when we see a lot of anomalies, we get out of those shorts. So when we see an anomaly on second, this is yesterday's activity, but this is previous day's activity. So that is why one of the reasons we say, like, it's better to remain neutral when the whole world is crashing. Nothing to lose when you're taking neutral stand. It is because there is an anomaly. There is 6 anomalies means markets are getting more and more emotional. That is why we call that a Jan 3rd as a poor structure. We call it as a poor structure. Poor structure are like gaps in between the buildings. When you find more and more gaps, markets often go and repair it back, right? And so my observation was like Bank Nifty holds 4 anomalies, and Nifty was already having 5 anomalies sometime back. I posted on 3rd of January saying that day holds with 6 anomalies, which is not a good sign for the continuation of the short. We are already shorting Nifty, right? So when we seen that 6 anomalies are there, we stepped away from our shorts. And even my observation on that day is like that particular day on 3rd of January is like not an immediate place to go long, but wait and look for change in the market confidence if you need to go long. But definitely risk is there in holding positional shorts. So we give up our shorts and we waited for the next day. That the very next day, it's a Friday, it's a very confusing activity, and we want to wait for further for Monday onwards. So it gives you a direction, like the GPS, right? So those anomalies gives you a direction. Okay, it's completely going down and down and down. Now you are seeing a lot of anomalies. It's a poor structure. It's tough to trade in the direction of the downtrend now because there are a lot of anomalies there. Price could snap back. That's the very first clue you might get, no matter whether you're trading crude or gold or silver or any other trading components. Whenever you're seeing too much of anomalies, that is a sign that it's from the emotional participants from the markets. So one of the place step away from what you're doing. So if you don't try to trade in the direction of anomaly, step away. Even if you want to short, you resume your short from tomorrow morning. Let the tomorrow morning market show some good selling confidence. Then again you resume shorting. Otherwise, you stop doing what you're doing and look for some other clues. Look for whether there is a trend change is going to come. Then you can continue. Or probably when the entire world is crashing, right? We will be under a bias that this market somehow has to break. We want the market has to break, but the market itself not breaking, right? When the market itself not breaking, then you have to do what the market is doing. Either step away from the game or you do what the market is trying to do there. Definitely not your bias. Definitely not that the Nikkei is crashing, so Indian market has to crash. US market is crashing, so Indian market has to crash. There are a lot of bad news on China, so Indian market has to crash. It's not that way. So anomalies are one of the fantastic clues. The second thing comes 45-degree line. We already talked about the 45-degree line. It is like here is the value area, developing value area, today's value area. More activity happens and something would have been happened. Lately, price plunges. It plunges fast. It plunges fast, and lately the recovery comes towards the point of it comes and closes towards the point of control. It looks like a 45-degree line. The profile itself looks like a 45-degree line. And of course, this is only for the bullish setup. There is no bearish 45-degree line. It's always only bullish 45-degree line. And if the 45-degree line, it's a very first sign that the market could do short covering. The market could do short covering. So whenever there is a 45-degree line, you have to be cautious on your shorts again. Market could do short covering from the next day onwards. From the opening itself, it does short covering rallies most of the times. So the who are selling below the value area low. This is the value area low here. Value area low here. Whoever is going to sell below the value area low, they are most likely to go get trapped into those reference levels, right? So again, we call them as the sellers are getting short in the hole. Very next day, the auction is likely to be bullish. They kickstart the auction in a bullish mode. They're not theories; they are practical observations. And it's been time proven again and again and again and again. So you need to know when the 45-degree line is getting formed, you should be in a position to recognize those 45-degree line. Right. So that's how the trading worksheet has been designed. So maybe I can show you the initial glimpse of the trading worksheet. I'm working on this trading worksheet to make it better, but this is a primary version here. What you have to do. So you'll be doing an pre-market references. When the pre-market starts, we'll be marking all those reference lines, and we'll be having an understanding where the market is most likely to open. And pre-market, is there any news-based impact is on? Is there global markets? Is there any major global market reaction is on? Why the market gap down? You need to have the reasoning. Why the market is opening big gap up or big gap down? You need to know the reasons. Like Monday market is about to open with a big gap up because the global markets are went positive last Friday because of China rate cut. Some Chinese rate cut sentiment was there. So because of that, all the global markets does a strong rally. US market went into a rally, so that will impact Indian markets. But after that, market will be doing something else. Once the market react to that news, market will be doing something else. So we need to figure out what is going to happen, right? So and then we'll be doing a basic inventory check, which I'll be talking about later on. What are the major reference level I have to watch for today? That is again, you have to write down all those reference levels. What is the high probability auction zones? Are you seeing any AB poor lows or failed auction, G2, G3? Any auctions you are anticipating to touch in nearby with the context why you are anticipating that, you have to give a reason. Are you seeing any poor structures? Are you seeing any anomalies from the charts? So you have to do a preparation pre-market. Before the market starts, you need to write up all these things so that you understand that there is a poor structure is there on last Thursday, so that you have to prepare it. If there is a poor structure, you have to aware about this information. There is a higher odds that it can get cleared. So that is one of your high probability auction zone that poor structure can get cleared. If there is an AB poor low, it can get cleared. If there is a failed auction, then we need to give a weightage, higher priority to it. If there is a G2, G3, we need to give a weightage to it. Likewise, we classified some 25 to 30 styles. All these things you need to check, right? So as of now, these things you need to do a primary check. If there is a 45-degree line, that means the auction can be bullish very next day. If there is a P-shaped profile or a B-shaped profile, then it means something else again. If there is a rally high or a pullback low, then that will act like a potential support or resistance for the next day. If there is a stealth auction, then the market could do a contra trades the very next day. So almost you need to go through all these of 28 round checks unless you're getting familiar with these concepts. So all these things need to be recorded before markets while coming into the session, right? Probably you need to fill up all these sheets and send it to me back every day. And I'll be showing you for 1 or 2 trading days. And then the very next day onwards, once you get familiarized with all these terms, your first duty is to fill up all these sheets so that you are you are cautiously dealing with those reference levels. This is pre-market setup, and post-market will be once the market started running in, we'll be measuring the market confidence, which I'll be explaining tomorrow session. How the market confidence at 9 o'clock. What is your observation, the key reference level? Are you seeing a rejection or an acceptance? What is your interpretation of point of control activity? Is it migrating or not migrating? So those are frequent activities. You need to list down at 9:15, 10 o'clock, 11 o'clock, 12 o'clock, 1 o'clock, 2:30 and 3 o'clock. We'll be doing frequent observations. So at least in a day, minimum 7 observation has to be happen during live market hours. And this has to go as a daily routine practice to handle any kind of market situation. So that helps you to sharpen your market observation skills. That helps you to spot trading opportunities better. Rather than I am showing where is the trading opportunity, you will be able to spot the trading opportunity once you are going through this round of process. Right? Initially, it looks like difficult, but over a period of time, it will be a cakewalk for you. Because you'll get familiarized with all these terms. Initially, the terminologies are too high in market profile cases, but what I request you is to take some initial plunge, get deeper into market profile, and do fill up all these sheets on day-to-day basis and send it back to me. We'll evaluate it. If there is any corrections, we'll help you to remove those barriers. Right. So if there is any learning barrier, we'll help you to remove those things. If there are any basic doubts, I'll be behind your back to help you on these setups. Okay. So anyways, I'll be talking about this during daily market commentary. We'll be filling it up, and I will fill the sheets before the market starts, and I will send it to you, and we will discuss about it. For 1 or 2 days or 3 days, I'll be filling all those sheets, and later on you should start filling all these sheets, right? So maybe this is the primary version, but the next version I'll try to make it in which one to give more priority, which one to give less priority, which one to give medium priority. We'll classify it, and then I'll send you the final sheet. But as of now, let's talk only about the basics here. Okay. So I haven't sent you the profiles worksheet because I want to classify into high priority, medium priority, and low priority here. So importance of point of control. We talked about point of control migration, right? So we also talked about if there's more than 10 TPOs, we call it as a prominent point of control or a very prominent point of control if it is more than 12 or 13 plus TPOs. So whenever you're finding an 10 or 12 TPOs, as the general rule says that that will reduce the odds of upward continuation. When you are seeing an point of control, we have a specific rules, strategies on point of control. So one of the case, you look at this example here, there is a prominent point of control formation here. Price opens gap up. Price opens gap up. It got back into the range, and often it acts like a magnet. It goes and revisit those levels, right? There are days. What it happens is here is that there will be a prominent point of control. The next day will be a prominent point of control. There will be one more prominent point of control over here, and price opens. It clears this point of control, and it clears the other point of control over here as well. Point of control are short-term reference levels. So they act like a magnet and they have a tendency to clear back. Maybe I can show you live some of the live examples, what happened in Nifty or Bank Nifty. And those are primary target levels. As I said, those could be one of your primary target levels. So the prominent formation over here, and price plunged. That particular day, it was a prominent point of control. Next day opening, the point of control got cleared. It got cleared because variety of reasons. Because it's one of the day where there are 3 anomalies there, 1 and 2 and 3 anomalies, right? And it is also kind of an. It's also the value area was building higher. The value area was building higher. See, that value was building higher, but price ended lower here. Price ended lower here, but value is building higher. Right? These are the signs that they are signs of an. They are not an weaker markets. Many people see the price and they take trades over there. They say like price ended lower, so price closed at the extreme. So go and do short selling. That's one of the bad idea. But if you look into the structure itself having 3 poor structures, I mean 3 anomalies, which is not a good sign to continue on the short side. Value was building higher. Again, if it is a trend following market, you will see continuation on the very next day. Very next day, either value area will be overlapping or very next day value area will be building higher. Right? So again, if you look pretty deeply here, you might find one more weaker levels here. See, there is a prominent point of control. Again, there is a sign that the selling is only from the short-term trading community. So if there is no serious selling happening, then auction could completely reverse back. So that means it's not one of the good place to continue on the long side. Why I will not continue? I mean, it's not a good place to continue on the short side. Why I will not continue on the long side? The reason one is value was building higher. The value was building higher compared to the previous day. That is one reason. The second reason is that you see that there is a spike which is coming over here. There is a strong spike coming over here. There are a lot of single prints here, a lot of single prints here, a lot of single prints here. And you see the point of control is over here, above the spike. So the selling, last minute selling which is coming in, it's not a good selling at all. If it's a good selling, what happens? It has to plunge down and more activity has to happen. So again, that is a weaker selling. I would say that I will term that as a weaker selling because it's not able to surpass through this single print zones. So that is the second reason. First reason I said that. What was the first reason I said?
Value area
value area is building higher. The first reason is value area building higher. And the third reason is the anomaly. And fourth reason is the prominent point of control. So we don't look only one information we don't trade that. So we look into the sequence of information, try to understand the surrounding situation, try to evaluate the surrounding situation, and then you try to evaluate whether it's a good selling or a bad selling. If it's a good selling, definitely this will plunge below this single print zones. It does more activity, point of control it would have started going down, right? Again, if you look on the second day again, it tested the prominent point of control. It took a drive and see that it becomes a P-shaped profile. The profile looks like a P-shaped profile. Where the activity started at the bottom, it moved to the top. First 1 hour, it went to the top and activity went to the top. It forms one more prominent point of control. again, that is a sign that it's a short-term buying activity. Again, one more short-term buying activity where the point of control touched. Again, there is one more prominent point of control where price initially went down, but it touched the prominent point of control. And you can find that prominent point of control often it's acting like a magnet. So every time, no matter what, how much bearishness, you see the bullishness which came on this particular day, on 1st of Jan, look into the 1st of Jan. Lately, price was rallying like anything. First, price started here, it went down, it forms a prominent point of control. Lately, price was spiking up, where you can see that the point of control is not migrating, only price is migrating. So who does this? When the point of control is not migrating, when price is migrating, who is responsible for this action? It's mostly the people who are responsible is mostly from the laggard trading community, right? So they chase the momentum, they keep on chasing the momentum. That is why you get something like this. You don't get an point of control migration, only price get migrated. And that too, it is a prominent point of control which acts like a magnet. The very next day, price opens here, it comes and tested prominent point of control, right? So it often acts like a magnet. So even if you go and look back into Nifty also, you'll be finding that those prominent point of control levels got touched. Prominent point of control which formed, it's keep on extending until it got touched. The moment it touched that particular day, it ends. It won't plot the point of control at all. So that's how the tool has been designed in the Bell Market Profile Ultimate. Again, there was one more prominent point of control here. Again, that also cleared the very next day. So often point of controls brings you to position yourself in an interesting manner. But as of now, there are no, all the prominent point of control, the prominent point of control formed over here, it got revisited, here it got revisited, here it got revisited back. Now there are no much of prominent point of control over there. Right, so prominent point of control is often a very interesting setup. Now, one of the interesting setup which I'm going to show you, that is one of the signature trades which happened very recently last month, that almost given 500-point trading opportunity in Nifty. You can't believe it, right? So we also talked about it when the event happens. We also talked about it. I also said in a webinar why exactly it is a signature trade. So you can go to market profile and be able to get an. I mean, the people who attended already from the community knows, of course, Ramesh Reddy is here in this group. Maybe he also attended the same setups. We talked about that setup. Let me bring out that. How to prepare for seasonal signature trades, right? So in this example, I'm going to explain. So I already, you can go through this link for why we call that as a signature trades. So this is one of the example which recently happened in Nifty futures. Oh, sorry, it's Bank Nifty futures. Nifty also having similar information, similar trade setups. You see here, this is one of the prominent point of control. Value was migrating lower, and one more prominent point of control, it is not testing back. And one of the point of control, it is not testing back. And there are total, there is one more prominent point of control here. I mean, this is gap, so it's supposed to get cleared. If there is a gap, it's supposed to get clear. So we don't consider this prominent point of control. So one prominent point of control here, second one, third one, and the fourth one, right? So there are 4 prominent point of control in a row. It happened without revisiting back. It happened without revisiting the those information. So when this happens, market have a tendency to revisit all the prominent point of control, These kinds of setup doesn't happens very frequently. Hardly this happens. Last year once it happened, and sometime back it happened in Nifty or Bank Nifty somewhere during May 2017. And this happened during November month. November month it happened. And what typically it happened, the reaction to the market was initially it goes and cleared this, price went down, again it comes and clears everything there. So if I go and get you the December charts of Bank Nifty, let me get you the December charts of Bank Nifty. So Bank Nifty. So we got the signature trading opportunity. By that time itself, we are bullish. Right? You see that these are the four trading activities supposed to happen. Now, this is one prominent point of control. Second prominent point of control. Third prominent point of control. And fourth prominent point of control. So when you are having this kind of four prominent point of control in a row, it usually goes and clears in a phased manner. So you see this activity, point of control was here, right? So one of the day it clears two prominent point of control. When there are more than 3 or 4 point of control which is not cleared, which is a sign that short-term sellers are present. Short-term sellers are present in this prominent point of control. Second day, one more short-term sellers are present in this point of control. Third day, prominent point of control is there. And fourth day, again, one more short sellers are present in the market. They are mostly short-term traders. Short-term traders, 4 days in a row, typically it's saying a sign that all their stops, all their short-term stops are getting built in this band, right? So your expectation is towards till this level, the market could do an activity over here, right? So first what they're doing is that first they're coming and clearing in a phase manner. Again, next day, again, value area started building lower. Again, one more day lower because the elections is supposed to come. The election on the election day is what 11th of December. There was a big gap down, but again, you are seeing one more prominent point of control, over there. So still that means 3 uncleared prominent point of control was there. On the election date, they opened with a big gap down. Right? So we had a discussion one day before elections. On the day of elections, we had a discussion. Maybe I can show you what was the commentary on that day. So we talked under order flow. One of the community webinar which we done under order flow. We talked about Nifty future trading activity. Nifty future order flow activity on election results. So this particular date. So the video here, I'm going to run the video. So last 15 minutes we discussed about the Bank Nifty auction. Yeah, any other anything out of it? $180 per connections, global CD balancing. There is a lot of crisscross happening below the 14 November low. So it was a kind of a low selling confidence, I would say that. And they scale back up. When they scale back up, it becomes an G3 pattern, right? There is a G3 high pattern is there. That is one of the things which I'm watching. If you understand G3 has the odds of testing in T+2. There is one more failed auction there. Already we done T+1. And a lot of prominent point of control. One more prominent point of control. ORR top. We would like to rate this ORR top as a weak ORR top. This temporarily price goes down, but eventually they will catch everything back up. So I'm expecting there are a lot of congested reference levels. So how many reference level we supposed to clear? One prominent point of control. 2 prominent point of control, 3 prominent point of control, and 1 G3 high, 1 failed action high, and ORR top. In fact, all are saying that all are short-term players, right? So most likely they are going to get taken out in a week or so, right? So that's what I'm expecting in a 5 or 6 trading sessions. We should be at 27,000 plus. Right? And interestingly, the bank, HFC Bank, so far the high is AB2 high. If you go and check back the chart, you can understand that so far the high which is established is not a secure high at all. So HFC Bank has to do a lot of activity there. So with this, I'm just I'm expecting G3 high to be tested in next 2 days, or maybe by tomorrow itself. Who knows? And the best scenario within T plus 5 days, I'm expecting the price to take out this 27,000 plus by breaking the December 1 high. Right. So far the December 1 high is the GDP day high. GDP announcement came, price stopped down in the first minute itself, and so far we've done all the downtrend we had seen is right from the day 1 onwards. We done that. So now I'm expecting a V-shaped reversal towards the first December high, both Nifty as well as in China. Okay, that's the commentary which was coming on exactly when December 11th. The same day we had a webinar to discuss about the order flow trading activity on election results and what kind of opportunity presented from what kind of exponential setup which presented from the market profile point of view. So these kinds of views, like so we given importance to time. Here we given importance to the trading reference level. Precisely, we have a context why the short covering has to happen. So I'll show you how we talked about this G3 high, right? So the G3 high is what I said, like 1 or 2 days we'll anticipate this to get clear. In terms of time, so it comes and clear the very next day itself. That is closely an 400 to 500 point trading opportunity there. And the other weaker levels as the time passes out, it goes and takes the ORR. It completely scale back the entire activity, which was almost 800 points right from the day low to the top. And again, it took the day ORR. So it took 4 days to clear the entire reference levels. So one of the things you have to know is that which is an exponential odd, which is not an exponential odd. If it is an exponential odd, how you have to prepare yourself. If it's not an exponential odd, then what kind of risk reward ratio opportunity is present in the markets. So these kinds of risk reward ratio opportunities usually doesn't happen every now and then. It happens every 6 months once or every 3 months once. But when it is showing up, you should be in a position to take such kind of trades, right? So in a shorter span, the market comes and smashes all those players, but prior to that, it will allow the weaker hands to set in, and then the institutions come and trade exactly against them. First, you need to know who compete against you. If you know that all these are weaker hands, how do you know that all these are weaker hands? There is a prominent point of control formation here. Again, there is a prominent point of control formation here. Again, there is a prominent point of control over here. And as the day progresses, there is one more prominent point of control over here. These kinds of setups doesn't come very frequently. Most likely, most of the prominent point of control gets cleared faster. And very rarely a 3 prominent point of control in a row or a 4 prominent point of control in a row, it's get left uncleared. And that too, as the time progresses, you got a failed action, you got a G3 high, you got a failed action levels. Again and again, everything is saying that this is completely you're dealing with a weaker hands. So one of the best trade location to initiate a long here. I initiated a webinar here because I'm seeing an interesting opportunity here. I written about it because I seen an very good, interesting trading opportunity there. Those are the places where your mean reversion bets are much ahead of any other players here, which puts you in the innovator mode, or which puts you in the early adopter mode, right? So at least you need to justify that this is a risk in holding shorts. When the entire markets are crashing, the US markets are crashing like hell by that time. When the US markets are crashing like hell, how do you recognize those change in the markets? So one of the very good changes that price opens gap up indicates confidence, and there was a straight drive. So even if you are short here, somewhere in this zone, you should get out of this game. So it avoids you to not to take a bad trades also. The process will help you to spot exponential positional setups also and intraday setups also, right? Okay. Now come back to the PPT. Are we clear what I'm trying to talk about it? If you have any questions, you can ask me. There is a question from Halesha Basavraj. In Nifty and Bank Nifty, how long it takes to revisit the price? It means how many days it will take to come back. So whether when the price revisit, it depends upon what kind of reference level it is, right? So something like a point of control, we usually don't have any dates, but usually it gets revisited faster. It can happen revisit next day or 2 days or 3 days. But if it's a failed auction, it has a timeline. It should happen. It should revisit within T plus 5 days. It should T plus 5 days. T plus 5, less than T plus 5, it should come and revisit. If it is a G3 high, it should come and revisit in T plus 2. Or if it is G2 also, it should come and revisit in T plus 2. Right? So there are certain reference level have a timeline. Certain reference level, they don't have a timeline. Something like an AB poor high or AB poor low, when it comes to indices, usually it revisits less than 5 days. Or something like stocks, it can go up to 20 to 25 days. So when we are talking about references, we'll also talk about when it could come and revisit back. So maybe I could, over a period of time, I could give a brief guideline about how we can go with this.
So, Rajendra and Ramesh, question on this.
Yes.
So, see, 3 and 4 permanent POCs until 6th of December, right? And 7th December, it started clearing off.
Yes.
It started. Now, but even though we see, the 7th December from there, then it almost went down by another 26, 450 is what on the December POC approximately.
Yes, exactly.
From there, it went down to below, I think, 26,000, right? If you see 11th December low.
Yes.
So if you were to manage the trade, right, what is identification of this?
See, one of the thing what we will be doing is that whenever there is an event is happening, we know that event is happening on 11th December. 11th December is nothing but the, what is 11th December? Can you explain why 11th December is it's an event day, right? It's an election results day. On that day, 2 election results are going on. One is Rajasthan election results, and second one is the Madhya Pradesh election results. So one of the things what we do is that we don't trade on event days, no matter what, how much ever odds are there in the markets. One of the key rule what we have is that no matter what, you come and take a trade on the event days only once the market reacts to that. Right? So means you can go through most of the events. Maybe I can watch out I can talk about the same webinar. I explained why you should not trade the events. Maybe I'll run it.
They're very volatile, and you tend to
not very volatile. We have a specific patterns why you should not trade the events. So let me start with the session here. I'm not sure how many people you would have noticed these things. The price stopped. Okay, so maybe I'll start here again. So why particularly today is there are a lot of correlation. We already talked about the election results day, right? So probably we talked about Bihar elections, we talked about the Gujarat elections, we talked about the Karnataka elections and many other elections. They have a lot of similarities, right? If you compare the how Nifty reacted to the older election results, you might find similar patterns over there. So one of the patterns I'm going to talk about over here, this is Bihar elections. The Bihar elections happened during November 2015. It used to happen, the election results came on Saturday or Sunday. Probably, of course, the BJP lost in that election. And when they lost, the very next day, price opened, Nifty futures opened gap down closely 180 points. It was down by 180 points. 180 points. And the chart what you're watching here is the 1 minute chart. So from the chart you can clearly see that the bottom came in the first minute itself. So first minute itself, the bottom came, and rest of the day, despite BJP losing the elections, right? So there was a complete rally. It exactly goes and closes the gap as well. Almost it goes and closes the gap. That's what it happened during Bihar elections. Right now, next comes the UP election. UP elections, BJP won the state polls, right? So there was a 150 point gap, 150 point, almost 200 points gap, right? So they closed around 8940, but then they opened around 9150. That is almost 200 points gap. So this is almost plus 200 points gap. 200 points gap up. And we think about here again, something interesting you might see it over that particular day. The price stopped exactly in the first minute. Right? So first minute, the price stopped. I'm not sure how many people you would have noticed these things. The price stopped. So that means some sort of an extreme emotions are going on in the people's mind, and they are taking the decision, and that decision stops immediately. And then profit booking started coming into the markets. This is with the UP election. And next, I'm going to pull up the next election results, which is the Gujarat election results. The Gujarat election results, of course, it is even more bigger one. The gap was almost 400 points down. It's almost down by 400 points down. 400 points down. Right, so that's almost 400 points. But think about where exactly the price bottomed out. The price bottomed out in the very first minute. Very first minute, the price bottomed out. From there onward, it was a mad, relentless rally. Almost it gained whatever the point it lost. Right? So that is with Gujarat December 2017 election results. Of course, hardly 1 year back from here. And if you move slightly to the forward, we get Karnataka election results. This happened 6 months back, 6-7 months back. This was slightly different because the election polls are happening during the live market hours, and kind of a clash was happening between BJP and the BJP and Congress. So there is a tie about to go for kind of a tie is what is went on, and there was no clarity. But then, of course, the market made it stop in the first 45 minutes. So instead of first minute, it took in the 45th minute, around 10 o'clock. Around 10 o'clock, there was a top in the market. Somewhere around 10 o'clock, there was a top. And from there, price slided almost 400 points. 400 points it slided at. Right? 400 points down positionally from here. And this is the only one exception case. Otherwise, in today's activity, this is today's activity, Rajasthan election. So we can see that, of course, the opinion polls are saying that BJP is going to lose the elections in Rajasthan and Madhya Pradesh and other places. But at the same time, yesterday evening, there is one more news was floated on. Mr. Urjit Patel resigned his job as an RBI governor. So that adds more intensity to the news. And in fact, price opened almost 150 points down, 150 points down, minus 150 points down. Approximately 150 points down. And think about where the bottom came. The price opens here. It was almost 150 points down, and there was a quick sweep into that. So the bottom made in the first minute. Again, today session that is. I'm going to show you from the order flow how much difference it makes. What kind of clues it gives from the order flow, and how.
Okay. I'm going to stop here. Right. So one of the reasons why we don't trade the events is that we never know which side the market will take a direction. It's more of an binary event. So whenever the binary event is there, we allow the market to take an opinion, and then we come and exactly we trade against the crowd opinion. Definitely, crowd will have some sentiment, and that sentiment will never last long. And we are still to monitor it. We have other tools like order flow to understand whether this is a crucial level to enter or not, or whether the market will take a support or in the first minute or not. Those are the other justifications which I have given here, how to deal with those kinds of election days, or something like a GDP announcement is going to come, or an Brexit kind of events, or demonetization kind of events. Because of that, market is open with a big gap up or big gap down. The scenario remains the same. Most of the times, the market will bottom out or top out in 1 or 2, 3, 4 minutes. If you look into the demonetization, market opened with a big gap down, market bottomed out in the 3rd minute, right? So these kinds of things, we call that as an extreme reactions to the news events. And then people takes an opinion, people take a direction, but that direction doesn't last long. If you want to know which direction it is, you have to stay away from the event, close all your positions, and come back to the market neutral. Let the market takes an opinion, and you come and trade the market exactly against those crowd opinion. Right? So it works again and again and again. And not only in Indian markets, we also seen similar situations in US markets and across other markets as well. The scenario remains the same. People are going to react the same way whenever they're going to react, and every time they overreact. And that is where you can make use of this as their trading opportunity to trade against those weaker hands. And one thing is that always you should have a standard practice. What are the positions you are having before elections or any known events? If there is any known events is happening on, let it be earnings season, let it be an GDP announcement, let it be any or overnight Fed announcement. First thing you have to do is that no matter what, how much opportunities are there present in the market, step away from it and start resume your operations from next day onwards. Let the market react to it. Let you miss one good opportunity, it's fine, right? So step away from it and then resume back your operations from on. Try to trade against those crowd opinion here. One of the places where you should be trading against the crowd opinion over here. And these kinds of opportunities doesn't come probably every 4 months, once or 6 in a year. At least one state elections will be coming in. So that gives you a tremendous opportunity where your at the money options or out of the money options will be doubling or tripling. So those are the places where you find a quick double or a triple in a day. So you should be waiting for these kinds of opportunities to take a trade there. One good thing what you have to do is that step away from speculation, stay outside, and come back to go back neutral, come back on markets. Let the market takes a direction, and you take a exact counter trade against the markets. That is where your risk involved in terms of price, in terms of time, is very, very. You will be able to spot a very thin risk markets trades over there, right? So, any questions?
So if you can go back to the chat, Rajendra.
The election charts?
No, the December month.
Yeah, so.
Okay, so what we're saying is, the best opportunity, since there was an event today, we just ignore it and then look at the 12th of December.
Yes.
And use that as the, for positioning the trade or initiating the trade.
Your trade positioning would have happened at 11th itself. 11th itself, the trade positioning would have happened.
Oh, then itself, is it? Okay.
Then itself. But then I want to showcase that this is a continuation. This game is not over yet. We are going to go back and test everything back.
Right.
Right. So, of course, when there is an RBI event, you have to go back to neutral. So I'll tell you when are the places you should be stay away from taking a trades. So when there is an RBI announcement, RBI policy announcement, you have to cut your position, go back neutral. Even we don't run systems at our place, we run a place called Traders Cafe where we run algos. So we go back, we close all our algo position and we put a complete ban during RBI announcement. We'll resume our operations once everything returns back to normal. So RBI policy announcements, you have to stay away. General elections, state elections or state or central election. 1 day before, you have to go back neutral and resume operations from next day onwards. And so these are the place GDP announcements. it has an impact because you take last 2 GDP announcement. Again, you can find the same pattern. So I also record the same patterns as well. So let's say I used to record in a portal called mrkt.co.in. So where, so this is one when the last GDP announcement came. Again, you can find the similar pattern over here. GDP usually happens on Friday, so Monday market opens. This is the first minute. It's a 1 minute chart, and market was opening on Monday. It made a high, and then it came back in, and that is from there. It almost crashed 10,625, and again on December 11 we made a low of 10,325, somewhere around 10,325. So almost that's a 600 point crash from the GDP announcement. So again, you should be able to recognize that it's an we can use other market profile principles as well. Like let's say this is my previous day high. This is my previous day high, right? Market opens here. That's an announcement was there. So market plunges back in, and my point of control started doing activity over here. Point of control activity is here. Again, lately it is migrating on the downside. So these are the signs that it's not a good buying. If it's a good buying, what happens? Price opens, they break the previous day high. Activity should be bringing above previous day high. That is not happening. So it's not a good buying. So what is happening here is a weaker hand buyers who were bought are weaker hand buyers. That is why price immediately got back in, and more activity happening here. You will be finding A, B, C, D forming over here. That itself a sign to go short. That itself a sign to go short, and you'll be able to fade those market activity either from an intraday perspective or a positional trading perspective. It gives a lot of odds. This is what happened during 7.1% GDP announcement came, and before to that there is one more GDP announcement came, and it's the same process there. This time it was the cuts was even more deeper. Almost it came around 11,750 levels. One of the historical, it's one of the 10 years we never seen this 8.2% GDP growth. For the very first time it's happening. The 8.2% GDP growth is happening, and it's a Friday. So Monday market opened. This is a 1 minute chart. This is the first minute candle, and this is a 1 minute chart. From there we almost slided towards 10,000. That is 1,800 point crash from this data point. So not every GDP data point you can expect the same thing, but if the markets are reacting at the open and the first 1 minute high is not taken out, as the first 5 minute high is not taken out, something serious with that, and market has started breaking on the other side, most of the trend reversal happens that way. So you have to recognize those nuances and act to that. It helps you to position yourself in a better mode on those days, rather than getting carry forward with those news factors.
So Ryan, one is the event identification, right? Where we see, again, this is not the norm that in every time the GDP announcements made, it will go so much of either downside or upside.
Yes, exactly.
What is the event which gets triggered? But what about in terms of the build-up, right? Indicators or
one of the places so most of the cases like events, not every events are going to be the market upturns or downturns,
right?
But when there is an event is there and you're finding call writing which is happening at the top, so maybe there may be 10,000. If you look into those terms, 10,800 is being returned strongly, and 10,000 later on that they shifted down to 10,700. But 10,700 is being returned strongly, and the markets are defending that. At times, what happens? Price could break 10,800, but eventually they will come back. That are the signs that the market is topping out. Where the open interest gives a real clue over there. Every clue there, even the last time when the price broken 11,000, call writers are present at 11,000 when the GDP announcement came. If you one of the cases during February 2016, Feb 2016, maybe I'll pull up Nifty chart and then I'll explain. Not every event day you have to trade at the open. That you have to remember it. But event days, which is combined with open interest built up, that gives you tremendous trading odds. So
Normally, one would expect 8.2% is a very good GDP, and we saw such a huge crash in the market.
Yes, yes. Typically, those are the places where you'll be able to spot a top before the general crowd picks up. So you think about this bottom. This bottom is where this is Nifty futures. This is one of the zone where the Union Budget 2016 was happening. On that particular day, 7,000 writers are steady there. This particular day, 7,000 writers are steady there throughout the February month. And that particular month, I mean, when the Union Budget was running on, that is the first day of the new expiry. And the intraday, they took a plunge of almost 250 points. But end of the day, when the price was plunging, still the option writers are steady at 7,000. And end of the day, they again snapped back and closed above 7,000. So that is how most of the times it looks like there will be an event. They will breach breach those levels from an intraday perspective, but at the end of the day, they will again restore it back. So
they were put writers, is it?
What is it?
Were they writing puts?
Yeah, they are writing puts there. And next comes the long-term capital gain. When the long-term capital gains are happening over there, so long-term capital gain happens over here, right? So exactly this level, that day they breached 11,200, but still the call writers are steady at that level. Event was happening. They broke it initially, but then they got pulled back in. Followed by that, there is almost 1,000-point crash from there as well. So events are very interesting. Most of the times, not every turn has to be come up with an event, but even event is there, and you find an open interest which is built in Nifty, either at the top or bottom. That is one of the places where you can find a market top or a market bottom. Right? So you have to be really cautious, but something like an budget events, we don't trade at the open itself. We don't trade the budget events. Budget events, mostly you have to wait for the budget event to over. Let the budget event get over, and the end of the day we come and get into the play if there is a budget event.
So this is one of the
most of the budget events will be like this. Most of the budget events, most of the RBI announcements, you can find this kind of patterns. Like market opens casually, it goes up, it comes down again. It does a lot of balancing activity. Again, it goes up, again it comes up, and it kills. Initially, it kills the stop loss, which is done by both the sides. Again, it kills the players who are placing stop loss on both the sides. You can find this kind of events in RBI announcement also. Initially, the market will be range bound. All of a sudden, by 2:15, when the announcement is supposed to come, some 15 minutes is there. They do some spiking activity on both the sides. When the actual announcement comes, they will be doing like this, where no matter wherever you're keeping the stop loss, your stop loss will be hunted. So these kinds of events, it is better to stay away from speculating the markets. Who gathers most of the money here is mostly the option writers who are writing on both the sides. They make money here because once the event is happening, IV started crashing in. Once IV is crashing, no matter what, the short straddlers or short stranglers will be making most of the money out of the volatility crash. So one of the primary reasons, if it is a budget event or an election, any ongoing event which is going to happen during market hours. Let's say the event could be coming around 2 o'clock. Let's say an earnings season is going to come around 2 o'clock. Better stay away from once the event is over. Once the stop hunting is over, then you can come and take your trade decisions over there. That is where your risk will be very less and very tighter. Otherwise, mostly it destroys most of our money. You will try to go long, market goes long, and you go long, market reverses its position. You again reverse to short, again market goes and it moves to the other side. So it will be very tough to take a judgment call during the market hours. But your risk and your reward will be superior once these kinds of events is going to get over. Right. So that's how you have to play the events. So we call that as an risk event days. Some of the days, like when it is opening with a big gap down all in a sudden or a big gap up and all in a sudden, we are the first one to trade against the markets. Right. This is where you find a very low risk trade setups. And if it is something like which is going to happen, market opens just like that casually. one of the best thing is to avoid that day, because market will be balanced, but it will be wider fluctuation you can see. But you don't find it's difficult to trade such kind of markets. So one of the thing to understand is that there are certain markets which are difficult. You have to stay away from this. Exactly, let's say tomorrow is a Fed day, and today you might find these kinds of fluctuations, and mostly the direction will happen after the Fed announcement days. So avoid those days when there is a Fed announcements. You have to avoid. Fourth is Fed policy announcements. Fed policy announcements. And the fifth one is, let's say, earning season when it comes to stocks, earning seasons, or something like an auto sales numbers, like where every first day of the month they announce auto sales number, which brings some volatility. Many people love to speculate on this volatility, but usually they get swirled into this numbers, so rarely they tend to be right. So these are the places. If you are trading auto stocks, you have to put a ban on trading auto sales number unless the number comes and the market reacts to that. Then you can take your opinion onto those numbers, something like that. Right. So, anyways, what is the time now? We can pass the session here, and tomorrow we'll resume back with all those reference level. We have more interesting trading strategies to discuss over here. And of course, all are applicable to live trading examples. And I would recommend you to go through the videos. The video which we done now will be uploaded in another 1 or 2 hours or so. You can go through the sessions. I want you to come back with all those refreshed principles, right? So, and most of the setups which we are talking about are not available in any of the textbooks, and most of them are available in terms of Jim Dalton principles. Some of the setups like G3, G2 setups, and some of the exponential trade setups like multiple prominent point of control. Those setups are not available in any of the textbook style. So, which is basically some of them are from my own observation, and most of them are the core foundation principles of Jim Dalton, nothing else, right? So, if you want to start with Jim Dalton book, Jim written 2 books, but out of that, one is Markets in Profile, and another one is Mind Over Markets. Mind Over Markets is what he written during in those initial days. It's his first book, Mind Over Markets. It's first book, but where he talked about only the basic concepts, mind over markets. So this is the first book from Jim, and the second book from Jim is what he recommend to every other trader. The second book is called Markets in Profile. Markets in Profile. Right? So where the second book is what it talks only about the context, about the trader's behavior. First book, it talks about very simple strategies: buy above this level, sell below this level. So he himself doesn't recommend the very first book. It's for the people who want to understand the terminologies. But the second book, it talks about the context in detail, how the long-term players behave, how the short-term traders behave, how the intermediate traders behave, how you can able to spot from the profile, and everything is explained from the behavioral approach, right? Yeah. Questions? Otherwise,
hello. Good evening, sir. Hello.
Yeah.
Hello, I'm Ramesh Reddy speaking, sir.
Tell me, sir.
Sir, I'm looking for market volume profile indicator for NTI. I'm unable to get in.
Well, it should be there.
Can you, sir?
The volume profile for the day, right?
No, sir. Like trading view chart, there is a trading view chart is there, no?
Yes, trading view charts are there.
And that in volume profile, one indicator is there. The custom.
I know that.
Yeah, that like that in NT8. I want that. In there is any suggestion?
Let's say, let me apply those indicators.
Oh.
So let's say I go to something like Reliance, because Nifty cash market doesn't plots
volume
Why,
profile.
sir? Why, sir? Nifty and Bank Nifty didn't flat that?
Because it doesn't has any volume at all. It doesn't has any volume data points, right? So it's not a tradable instrument. It's a cash market. But if it's a future market, it would have. But trading doesn't has that information.
Okay.
So I think you're talking about this indicator. I think. So volume profile.
Yes, sir. Yes, sir. That one.
Why it's not coming over here? Yeah, we're talking about these tools, right?
Yes, sir. Three different tools are there: composite profile and session profile, and whatever we want customized. That is customized very important. Like
yes, I'm going to expand so that you'll be able to see that. So these tools, this volume profile, right?
Sir. Yes.
The same volume profile you're seeing on the screen here. So the one here, which is next to market profile, is the volume profile here.
Okay, this is session profile. I think composite profile.
What do you mean by composite profile? Is already available in NinjaTrader NT8. It comes at free of cost. So what you have to do is that you have to open your NinjaTrader, right click, indicators, and they have something called volume profile. Just scroll down and go to indicators and scroll down. You will find the volume profile. This comes at free of cost. So it's by default included in the tool itself. So that plots the volume profile, which on the left hand side or on the right hand side. So just give me a second. It should be here anytime now. Yeah, where it is. It's supposed to come. Let me check what I missed. So volume profile. Calculate on each tick volume profile. We take a fresh chart. Let me apply. Let's say HDFC Bank. Press OK. And let's say we can go to indicators and get the volume profile tool. Click. Apply. Okay, maybe what I have to do is that I have to enable tick replay. So because it requires tick level information, so you have to go to data series and you have to enable tick replay. Because whenever it requires a bid and ask data, so something like this.
And in this value area high, value area low, and point of control can we get?
No, you cannot. You cannot get it from here.
Okay.
Yeah.
Okay, thank you, sir.
Thank you then. So any other questions? Okay, if there are no questions, then I'm stopping the session here. And tomorrow's session will be resuming exactly at 10 o'clock, right? Thank you. And the current videos will be uploaded in next 1 hour. So you should be able to get access to all the videos which we done in the morning and in the evening. If you still haven't got access, just connect with my customer support team. My team number, I'll again repeat it over here. It's 95351 Either Vani or Shruti will be there to assist you in onboarding you to the market profile premium portal, where you can watch the recorded videos, webinars, and the community webinars. Thank you. See you tomorrow, same time, 10 o'clock in the morning.